welcome. I'm Abha Bakaya and welcome to the BT Conclave pre-budget special. As the Finance Minister is all set to deliver the Union Budget for the year 2022-23, we take you through a series of special interactions with industry veterans. Stay tuned to watch the key budget insights from the corporate world, key policymakers, market veterans and popular academicians. First up, the revival of the unorganized and rural sector has taken precedence to boost consumption across the board. We catch up with market veterans to understand how the government can facilitate the investment cycle by managing fiscal policies along with the central bank's monetary policy. Listen in as BTTV's global business editor Udayan Mukherjee decodes all of this with Rashesh Shah, Debashish Basu and Nilesh Shah.
In this show, we'll focus on whether the stock market has any expectations from this union budget and should it have any expectations from the budget this time around, given all that has happened over the last 1 year and so. To talk about that, I have with me Rashesh Shah, Chairman of the Edelweiss Group, Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company, and Debashish Basu, Founder of MoneyLife. Gentlemen, thank you all for joining me today. Rashesh, let me kick off with you. As I said in my introduction, should the market have any expectations this time around? Because, the budget is a big media event. I mean, people like us make a big song and dance about it. But is it likely to be a stock market event this time around?
I think, like every year, I think what the finance minister says in the budget affects the mood and the sentiment. And the expectations. I think, fortunately, currently investors are in a good mood. I think I think everybody is very upbeat, in spite of the new variant and the fact that COVID is not over. I think people are looking. They are looking beyond it. Investors are looking beyond this. So I think the mood is upbeat. The only thing that would be there is no upsetting of the apple cart. So I think as long as there is no real downside, and I think people are looking at action from the government and the pronouncement from the government to get the investment cycle kickstarted. So if you ask me as an economic watcher, I would like to see government step up on spending. I think fortunately the Indian government has got room to spend. They have not used up the stimulus in the last 2 years of COVID in a big way. So I think if the government indicates that they're going to spend, it will increase the optimism that is already there.
What do you think, Debashish? Because, it is now quite established that this is, as everybody calls it, a K-shaped recovery. The bottom of the pyramid is hurting. The top seems to be doing quite well by all measures. Is it fair to expect a lot from a corporate or from a stock market perspective this time around then?
Well, the single biggest event, according to me, of the last 2 years happened somewhere in the middle of the year. Middle of the financial year, which is when we got a huge tax cut. So budget really had nothing to do. If you really take last 5, 7, 8 years of a series of events that have happened, that is the number one thing that completely changed the character of the profit and loss and the balance sheet of first the profit and loss and eventually the balance sheet of Indian companies. And it came at the worst possible time when the GDP growth rate for that quarter was just 4.2%. And that is the inflated figure, that is the recomputed GDP. In terms of the old GDP, it is still 2% lower. So it's the worst kind of a situation when you got the tax cut. So first of all, I don't think there is any correlation between what the corporate sector wants to see, likes to see, gets to see, really, and what the budget measures are. Year after year, there is this huge interest. There are tons of memorandum which goes to the government, lots of demands, all industry associations have their own list. Market has its own very, very narrowly focused thing, which is tax cut and capital gains and dividend tax and STT, and that's about it. They can't see beyond that. essentially, and then little wider perspective, which is what the corporate should be getting. But the government does what it wants to do. There are different themes in each year, but then the internal measures of any of these don't match up with the themes or what the government subsequently does through the course of the financial year. And finally, what actually events transpire, how corporates react, the external events, the international events, all that really are far, far removed from not only what the budget expectations are, but what the actual budget measures are. So I would really not put too much of weight in it.
Nilesh, there's a lot of people who say that, this time if the finance minister needs to do something, it is actually at the bottom of the end of the pyramid. I mean, towards rural India, towards India's health infrastructure, towards MSMEs, because that's the part which has been hurting. And while there is some tenuous link to demand from corporate demand from that aspect, generally this is not the area which the corporate sector or the stock market is very focused on. Would you agree with that? That this time's budget is probably more about not the top end of India's economy, but the bottom end?
Undoubtedly, Udayan. Today, trade, agriculture, private sector investment and government spending is above pre-pandemic. But unfortunately and sadly, consumption is below pre-pandemic. And as you correctly mentioned, it is the bottom end of the pyramid which is being hurt maximum. We are selling more SUVs than pre-pandemic, but we are selling less entry-level bikes. Clearly, government needs to step up to support consumption at the bottom of the pyramid. They did excellent job with a credit guarantee scheme of 3 lakh crore for MSMEs. But MSME cannot survive only on fixed income or debt. They need equity. How do we mobilize equity for them? How do we create reskilling of MSME entrepreneurs so that they can move from unproductive or uncompetitive, whether it's old economy or new economy, into more competitive scenario? And most importantly, can we even think of urban Manrega? In urban India, also there is a higher level of unemployment at the bottom end of the pyramid. We have seen rural Manrega or Manrega giving rural employment. Probably there is a need for that in urban India also. This time budget has to not only support growth, but also equitable distribution.
Rashesh, how important is all this for the purposes of the stock market or even corporate India? Because, I mean, we've seen the corporate numbers over the last 4 quarters. I mean, they seem to be on a tear. And while we are talking about this misfortunes of the MSME segment or rural India, or the big companies seem to be actually reveling in it. They're grabbing more share from these unorganized players, and their pool and their is only growing. But is there a point where the bottom of the pyramid actually begins fight this kind of demand growth that we are seeing? I mean, that's the key point at which the corporate sector will notice that no, we cannot continue to grow with 50% or 60% of India hurting so much.
Absolutely. I think, as you very correctly said, I think the stock market is a very small part and a small barometer of the overall Indian economy as a whole. And though I think what has happened last 2 years, the RBI policies on liquidity, as all over the world, all the central banks, I've always seen that any intervention by a central bank, any intervention through the monetary policy helps the formal sector and the larger corporates immediately, because that's immediate. And that is why I always say we need to balance the monetary policy with the fiscal policy. The fiscal policy, what the government does actually addresses the lower half of the economy, while what RBI does addresses the upper half of the economy. So I think the last 2 years, as all these central banks have loosened the purse strings, brought down interest rate, infused liquidity, the formal sector, the larger corporates, the larger companies have done well. And that was a good thing because it kept at least the economic wheels going. But we clearly see that consumption is slowing down in India. And as you know, consumption has been the key driver of India. So unless we revive consumption, and for that, the fiscal policies matter a lot more than monetary policy. Monetary policy works when there is a crisis like what we had in the last couple of years. But I think to revive growth and demand and eventually the capex cycle, because ultimately the corporates also will follow the consumption cycle. So we do think that the fiscal policy intervention is going to be the most important indication government can give. And it is time that government starts spending. If you look at the fiscal stimulus or so-called stimulus we have had in the last couple of years, they were also indirectly through credit guarantees and stuff like that, which all affects the formal sector. I think the direct spending by the government, there have been a few programs, but I think government needs to spend at least about 3 to 4 lakh crore putting money directly in the hands of people, which will start the consumption and the demand cycle, and that will fuel this current optimism, because this current optimism is partly based on liquidity and the monetary policy, but also partly based on expectations of growth. So if there is no consumption growth, then growth will start petering out, and that will affect all investors across the world.
Debashish, come in on this, because the key point is whether this K-shaped recovery, the larger companies benefiting while the smaller ones actually are doing pretty poorly. Is this a sustainable trend, or do you think the fact that a very large part of informal India is doing pretty badly, that actually has any ramifications for medium-term earnings growth, which is what the stock market is basically pricing in today?
There are a couple of issues. First is if you are discussing stock market and the listed companies, until now they're doing very well. All right. I wouldn't say last quarter's numbers of Hindustan Lever or this quarter's numbers of P&G, etc., is of much relevance. I would like to sort of see a much more sustained downtrend to be able to come to some sort of a conclusion. So also there are so many other sectors which are still doing extremely well. So overall, if you see the stock market is interested at any time in which sectors are doing well, which stocks are doing well. Everybody can't be doing well equally all the time, right? In fact, this is a golden period of the Indian stock market where the majority of the sectors and very, very large number of sectors, earlier, if you remember, in the mid to 2000s, or sorry, about 5-7 years ago, it was just about pharma and IT. And maybe part of the financials. Now you can see the electricals, some segments of even auto ancillary, you see textiles, you see capital goods, a large number of them are doing extremely well. And all that essentially has a trickle down effect, which is what it's supposed to be. I mean, it can't be anything more than that. If the capital goods companies are doing well, obviously ancillary suppliers to capital goods will do well, and so on and so forth. So I also think that we need different kinds of data. We need really high frequency data, which is now today possible. From the credit card purchases, maybe online sales, maybe different kind of employment data, which we can get from 2 or 3 of these listed companies. Their quality of data is completely different from the earlier quality of employment data. So it's not that I've gone into it, but I don't see from the surface I don't see there's too much of alarm over here. So I don't even agree fully, at least not yet, that there is any issue. The last quarter's issue has been a very sudden and very serious increase in prices, raw material prices across the board, right? And raw material prices have affected intermediate companies like B2B companies, chemical companies which were buying commodity chemicals and processing them, so they got affected. There's no question about that. And also companies which have lower value addition. So if your gross margin was lower and you're not a high value added company, obviously you're going to get affected. To some extent, high palm oil prices would affect a soap manufacturer and so on. But that's a very, very short term. I'm not saying that it won't get worse. I'm not saying it will only get better. I'm not saying at all. But I'm saying the period is too short for us to come to any conclusion.
Nilesh, Rashesh alluded to the fiscal space for the government. I want to bring you in on this because there are only 2 ways the finance minister can move this time around. She can either say that tax collections have been good, buoyant, and therefore I want to get back to the path of fiscal consolidation once again. Or she could say that because there is money to be spent towards the lower end of the pyramid, she will need some more grace period, maybe another year, and she would keep the fiscal deficit relatively high. Which one would the stock market appreciate more? More fiscal elbow room or getting back to fiscal rectitude?
So the best thing which stock market will expect is that government becomes innovative. It is possible to spend money and yet not leave the path of fiscal prudence. The two options for government are to raise non-tax revenue. In divestment, we have failed every year in achieving the target, no matter what kind of market it is. I think it is time to think about divestment separately. Maybe a holding company which appoints professional managers to monetize government's holding could be a better way to do divestment. The second thing is asset monetization. We last year announced National Asset Monetization Program. Banking system is flush with liquidity. Global investors are hungry for yield. Rupee is remarkably stable. And there is appetite for domestic investors also towards higher yielding securities. So using a better innovative approach to divestment and asset monetization program, finance minister will have revenue and also ability to spend money and yet walk on the path of fiscal prudence. Undoubtedly, investors today will take a fiscal roadmap towards fiscal prudence far more enthusiastically.
But Rashesh, I want your thoughts first on this fiscal deficit business. What are the bond and stock markets pricing in at this point in time? Do they believe that fiscal prudence will be back on the agenda, or are they pricing in that there will be extra spending on infrastructure or capex from the government and therefore we'll have a loose fisc for another year?
I think the expectation on the fiscal deficit, given that government A has got very robust collections as well as spending has been muted. And again, I think government's ability to spend is also fairly constrained because, unit projects, there is also the capacity in the government to spend, even if the willingness is there to spend. So I think what the investors and all are looking for is government will not really spend money on infrastructure, but maybe through some social programs, stimulate consumption. And the money for that will come through disinvestment. I think we still have LIC and BPCL and all that still ahead of us. So government has a fair amount of revenues that could come through disinvestment in the coming year. I, for one, do think government is holding it back and keeping it in their back pocket because they don't need it now. But in the next year, they should use that money to spend rather than let the fiscal deficit go completely out of whack. Though I think now between 6 to 8% is now the expected range and nobody will get spooked by that.
Devashish, what are your expectations? Because I've heard a lot of people actually make the case for government actually spending more on the investment side right now. But government investments or government spending on capex is a very small percentage of GDP. Do you really think it's very material that the government actually spends a lot and tries to crowd in private investment? Or given how well the corporate sector is doing anyway, the capex cycle should not be an issue. It should be managed by the private sector itself.
I have a feeling that this government is very conservative at the core of it, and they are not going to step forward and spend a lot of money indiscriminately on infrastructure and things like that. You're not going to have that. Number one. Number two, if you see a lot of initiatives in the business and in the corporate side are through companies. Let me give you an example of something which has become widely successful, and it should actually be a template for a lot of government intervention. And that is ethanol blending. If you see what it has done, it has stabilized the sugar prices. It's made the sugar mills absolutely in pink of health, which essentially means a huge amount of India's rural population, which used to live on sugarcane, their income has completely stabilized. It's a green initiative, it reduces emission, and the government has not spent a penny. All it has said is that I'm encouraging OMCs to buy ethanol from the sugar mills all around the country. So that's just one aspect of it. But number two, in the same way, it is now saying that I'm going to allow, ethanol made from waste. So when you say agricultural waste, it's not localized to where sugarcane can go. It can be agricultural waste is across the country, anywhere in the country. So the moment you now move into agricultural waste to ethanol, it's going to be another big move. And in none of these cases, the government is spending any money. And these are the kind of initiatives that we really need, where the government actually steps in to enable an environment where the linkages work so efficiently. And it's a win-win-win for everybody. I'm not saying that the same thing can be replicated in all kinds of sectors, but this is a template. It's the best possible template. But something similar is what is desirable. So my answer is in two parts. First is that I don't think the government is going to step forward and spend money, because their policies are production-linked incentives, which means you reach a target, I'm going to compensate 5 years later. So ethanol blending. In none of these cases, the government is spending a penny. And that is the right strategy, according to me, except that we need to now supplement this with, as you said, the much bigger discussion. And that is where I'm unable to understand such a bold government, so clear-headed, and why isn't disinvestment happening? So that's the third part of it.
And your point is taken, Debashish. And Nilesh, I want you to weigh in on this, because what Debashish is saying is that you don't need to necessarily lay out billions of dollars. You can actually facilitate through a policy intervention, and which might stimulate the capex cycle on its own. That point is taken. However, there is another view, or another school of thought, that maybe the government needs to spend something on, say, road construction, or stimulate something like real estate, which are large employment generators, and we need employment generation at this point in time. Do you think something like that may be coming in the budget, or needs to come in the budget this time around?
So we have seen government spending money on infrastructure. It has almost doubled in last 5 years. Government has to spend money on infrastructure. In 2014-15, the average speed of our goods train was 25 kilometers an hour. A marathon runner was running faster than that. Today, it has reached to 44 kilometers. It has happened because there is investment in railway, and there is investment in signaling, and so on and so forth. On dedicated freight corridor, goods train will run at 75 kilometers an hour. So there is a need for investment in infrastructure. We are moving from infrastructure shortages in most sectors to infrastructure availability in few sectors, and clearly government will have to take the lead. But in order to support consumption, as Debashish mentioned, you can create a linkage. Now, there are crores of taxpayers whose benefits on housing in terms of loan interest or principal repayment, it has remained same since 2014. The government has fiscal space. Can you give some additional incentive to them? That surplus money with taxpayers, they will go and spend money, consumption will get supported. It will also encourage housing industry, which has far bigger multiplier effect with very less import dependency. If you give incentive for new home buying, and today stars are already aligned for housing sector, so you are actually acting as a catalyst for accelerated growth. Today, citizens of India are borrowing housing loan for 15 years at a rate lower than government pays on 10 years. Work from home has created demand for bigger houses. Affordability of houses have improved for certain segments of society. Now, on top of it, you add something in form of incentive, and suddenly it creates demand for housing, which has multiplier effect in economy. And this whole virtuous cycle of jobs, investments, growth continues forward.
Okay, let's get back to the thorny issue of disinvestment. We can't keep it away any longer. Debashish, you have thoughts on it. I mean, Rashesh's view is that the government is keeping it in its back pocket. But the evidence of the last many years is that, this is not coming out of the back pocket at any point. Huge targets are set and we achieve a very small fraction of it. This year, what is the excuse? Because we had such a buoyant stock market, so many IPOs raising billions of dollars happened, but the government could not push through BPCL, IDBI Bank, forget the two public sector banks they said they would sell, or do an LIC IPO. What is the problem, you think?
I think there is, the government was distracted last year on a variety of, this is my guess, all right? But because I can't find any explanation for a government that is so decisive in so many other areas, whether good or bad, is not able to And it's not a new thing. It's not that all of these public sector companies are all 100% government owned. It will be a path-breaking first-time move. It's not that. This investment happened from 1992 onwards, and with parcels and packets and so on and so forth at that time. So I have no explanation for this except that it has been distracted, and it doesn't think that it is getting the right value, possibly. It is looking to do some kind of strategic sale. So these are the guesses one can have from the outside. The first one being the strongest, which is that this is really a top level decision, and the top level has been distracted with a lot of other things in last year. Because I simply cannot understand why it's not being done. In fact, my concern is not so much as BPCL and HPCL and further disinvestment. My real concern would be large government organizations which are unlisted, which are facing obsolescence, which have a real problem, which is namely MTNL and BSNL. So I would really like to see some sort of a white paper which puts out that yes, the government is in these sectors in terms of investment. These are the top 5 areas, and these are our thoughts. This is what we want to do in each of these areas, and I would like to see an Air India happening in BSNL to start with. I'm not so much bothered about BPCL being, going into private hands or not.
Rashesh, I understand what you're saying with the government trying to do it tactically, but could there be another issue? I mean, we are talking about bringing stocks to the market through investment bankers and selling it at a price. Could it be that the government is facing, something that we cannot see, a tremendous amount of resistance from maybe insiders in these companies, unions, managements, whatever, and the government is unable to cross that hump? The 2 public sector banks could be cases in point. Do you think it is something like that which is the obstacle? Because market timing and opportunity could not have been a reason this year round.
See, if you look at, I think government, like any other promoter, would like to optimize on the price. One, also the government also thinks long term, that you suddenly sell, and if those companies suddenly do very well, politically the backfiring could be a lot. I think Air India was an easy one because there was a clear public consensus that it needed to be sold, and especially with COVID and travel and all that. So I think government is also very sensitive, because what I have seen, that a lot of things like disinvestment are not just economic decisions, they are also socio-political decisions. So I don't think unions and all are the government is what worried about. Like you said, banks, I think banks are already on the mend. NPAs have come down. There is a lot of liquidity. The need for government to infuse capital in banks have gone away. In Air India, that was still there. Government had to infuse a couple of 1,000 crores every year at the very minimum in Air India, and that was hurting government. But I think either whether you take BPCL or the banks, government is not having to infuse any capital in that. So I think trying to wait, optimize, see whether the timing is right, because I think BPCL can get done, but the optimization on pricing in BPCL is very high. I think on LIC, there have been procedural things to do. So the reason LIC has taken the time it's taken is not due to any other reason, but LIC will happen off the block in the next 3-4 months for sure. So government has been focused on LIC. I think LIC IPO, what I read between the lines, has been the highest priority. Things like BPCL and banks have been lower priority. Maybe Air India was also higher priority for the socio-political reasons also, and the capital drain reasons also.
Nilesh, you've already given your formula for asset monetization, but you agree that in the next 3-4 months, LIC will get done, and maybe even BPCL?
As Rashesh Bhai mentioned, there is extremely high probability that LIC should happen in this financial year. A lot of work is going on, and we have attended one of the roadshow of LIC also, though they obviously didn't give the timeline, but investor roadshows have begun. So my feeling is that yes, LIC in this financial year, BPCL probably in next financial year.
Let's come to taxes for a minute. Is there anything that needs to be done on the income tax, capital market related income tax front, Nilesh? Either on capital gains, which most people expect nothing to happen, but also on securities transaction tax, tax on derivatives. Is there anything that is on the wish list, or there is a reasonable probability of a change?
So one market can pray for something, but in reality, I think no news or no change in the capital market taxation will be good enough. On a longer term basis, STT were levied in lieu of capital gains tax. And today, STT and capital gain tax both are coexisting. But not that market is today demanding STT removal. If it comes through, it will be a positive surprise.
You agree with that assessment, Rashesh?
Yeah, I think, as I said, I think the market sentiment is good, liquidity is good. People are expecting corporate earnings also to do well. So I think all the three engines of liquidity, sentiment, and earnings are on an uptake. So I think this is the kind of environment where actually no news is good news. I think the one expectation that not from the market, but from corporate India that has been there for quite some time is on the buyback tax, because if the dividend tax has been removed, then people feel the buyback tax is an aberration, and that should also be addressed. So if I think from corporate India, one ask that has been there has been on buyback tax. But otherwise, I think for most investors in stock market, the only ask will be there is no drama in this particular budget. It's a no drama, very business as usual budget.
Broadly, Debashish, would you agree with that assessment that, I mean, things cannot be too much better than what it is right now in terms of corporate taxes or capital market taxes? In that sense, don't rock the boat should be a good enough thing. I mean, no news should be good news, as Rashesh said.
Yeah, I mean, there are two aspects. One is the principle, what should be, and one is what is the reality, what you expect will happen. In terms of principle, a lot can be done. Buyback tax, dividend tax, STT, all of these are debatable in purely philosophical terms, in principle terms, in economic rational terms. But I guess the government is not going to listen to any of this. So, yeah, I agree. If nothing worse comes, that's good.
And Nilesh, what about the other thing which we talk about every year, but nobody seriously expects it to happen, which is wealth and inheritance tax? Anything floating in the wind, or best not to spend time on this?
So again, in wealth tax, government recognized that the cost incurred on collecting wealth tax was more than the wealth tax paid. And today on income tax side, we have seen excellent collection. On inheritance tax also, clearly, I think there is probably space for a small beginning. Today, when NRIs inherit property in India, left by their Indian parents, they still have to pay tax in US. Now, can we take advantage of this kind of opportunity where we tax those inheritance in India, and thanks to double tax agreement, it doesn't make any impact on NRI? It's far better for NRIs to pay tax in India for Indian properties inherited to them by Indian parents rather than paying tax on America. So we can try to catch this low-hanging fruits, but no change in wealth tax and inheritance tax will be a good news for the economy.
Debashish, just a quick question on taxes on tobacco, because that's one sector which always remains very volatile ahead of the budget. Do you have a sense of which way this could be going and which way it should be going? Because, I mean, there is a lot of talk that the government is trying to align itself to WHO norms of at least 75% of the retail price of tobacco products being taxed. Do you have a sense of which way tobacco taxation in this country is heading?
No, I think that the tobacco companies have a point of view that there's a lot of smuggling going on. And the government loses out revenue on that score. So I think, and there is a very, very strong logic to that. There is a lot of data to that. If anything has to happen on the tobacco side, the finance ministry has to take that data into account, really apply the mind and rationalize to ensure that the smuggled cigarettes are actually down. It's an important component. Apart from that, I'm not sure. I'm not privy to anything. I don't even have any thought on that. But I think that rationalization part is something that any government would want to have.
Rashesh, the other thing which happens is that monetary policy watchers also, or policymakers also, watch the budget very closely, because we are at a different end of the curve this year, where interest rates are going up globally. inflation is high in India and there is every possibility that the interest rates will rise in India as well. What do you think will be the monetary policy takeaway and the interest rate curve takeaway from the budget this time around?
I think usually whenever there is a change in the monetary policy, there are usually two aspects as work. I think the first one is it expected or not? If there is a shock to the system, like what happened globally in 2013 when there was a taper tantrum, there was no expectation, and then suddenly there was a knee-jerk reaction. Even COVID, if you see the first wave, there was a knee-jerk reaction, and then there was no reaction to the wave 2 and 3. The same way, I think interest rates going up has been priced in. So in the short term, it will not create a panic or any knee-jerk reaction. If the interest rates go up by about 100 basis point over the next 1 year, I think it's in the expectations and people will be okay. If there is a sharp rise of say 200 to 300 basis points, about 2 to 3% increase in interest rate, that will spook the investors and will create liquidity crunch and all that. So I think if it's a slow, gradual rise, which is in expectations, which is in the price, which is what everybody is expecting, that there won't be any sharp reversal, then I think we are okay, because the earnings growth and the growth momentum will offset the increase in interest rates. I think even on inflation, we are all expecting I think inflation will be high, and I think India needs to get adjusted to expect that inflation will remain between 5 to 6. It's still within the RBI tolerance range of 4 plus and minus 2. So I think between 5 to 6% inflation is what my expectation would be. And if it remains there and 100 basis point increase in interest rate by RBI with not too much liquidity reversal, we should be okay. If there is anything out of this, anything unexpected, then there will be a little bit of knee-jerk reaction and panic.
Nilesh, how steep or pronounced do you expect this interest rate upcycle to be? I mean, as Rashesh says correctly, anything up to 75-100 basis points is probably baked into expectations. But sometimes, you start at one place and you end up at another place altogether, depending on the data. But at this point, what is your expectation?
So as of today, we expect RBI to move in 3 compartments. First will be reducing reverse repo and repo rate corridor. It may happen in next credit policy. Second will be to change the stance from accommodative to neutral. It should happen probably in next 6 months. And then there will be repo rate increases. Fortunately for India, market has already discounted between 3 to 4 rate hikes. And at this point of time, it looks reasonable. Obviously, everything will be data dependent. Our monetary policy will also be driven by what Fed does or what our inflation number actually plays out. But as of today, we believe Indian interest rates, the market yields have discounted at least 3 to 4 rate hikes from RBI.
Devashish, you used an interesting phrase. This is the golden period of Indian equities. Is this golden period likely to remain fairly shiny through this year, or do you expect some chinks in the golden armor this year in 2022? Some turbulence?
Things can change very quickly. Depends on data, depends on global factors and so on. But the reason I mentioned that this is a golden period is because I have not seen so many sectors simultaneously doing well, for a very long time. This happened for a very short period between 2003-04 and 2006-07. But even there have been, I don't think, real estate was doing very well at that time, which it is not as of now, but it's picking up very strongly. So my point was premised on that. If we start seeing headwinds in sector after sector, one obviously will have to revise one's opinion. But Indian companies have gone through tremendous amount of restructuring, and they continue to do so. Right? It's extraordinary how serious and focused Indian corporate managements are today, even in the mid cap and the small cap space. They're really serious. And it'll take a lot of excesses for a very long time for that focus to go, and you start seeing all kinds of hanky-panky. We are not seeing that so far. The talent pool is tremendous. there is a segment in the market today which is where more and more private equity guys have come in. They are running whole companies today, whether it's a Crompton Greaves Electrical, whether it's a Sequent Scientific. But they are very focused. Their one and only one focus is performance. So I can see there is a transformation among the second and the third generation of large business houses. So, and those are templates today. People are changing. I can even tell you there are unlisted companies which were run in a certain way. The old man is saying, well, I want to get listed and I want a high quality board and I want to clean up my act and then come and do an IPO. So I see all of these things as fairly positive, even for somebody like me who has seen this for like almost 4 decades now. And there's no bigger cynic than I am. But I can see this transformation has been absolutely fantastic across the board, sector after sector. So it's a very structural change that I'm seeing in business and in management and so on. So obviously one has to keep tracking it every quarter, every year and so on. But as of now, it's been a great ride, and it's not just a reflection of low liquidity and so on and so forth. A lot of people say, well, if the Fed starts raising rates, what happens? Those are very, very simplistic assessments according to me. I mean, so many of these Indian companies today are actually, world-class exporters, which wasn't there earlier. By exports, we meant the low level of exports the textile companies used to do, and then software, and then API, the pharma companies. Now, in manufacturing, there are top quality exports. The last piece that I'd like to say is that expensively valued, very, very expensively valued, but the quality of IPOs that have come in the last 6 to 9 months have been exceptional. As I said, valuation is a different story. They have all taken advantage of it, but there are companies which are very, very well run. And one of the companies in the chemical space actually exports 35% of its revenues to China. China is an importer from it. So these are the kind of things that I'm seeing where obviously in the market, eventually you will go and buy a stock. You're not bothered about overall what is happening. You find a great company, you buy that stock. So I find a lot of very, very good quality companies today, very good quality management, and they have a really, several years, if not decades ahead of them.
Okay, on that optimistic note, I shall thank all of you gentlemen. Rashesh, Nilesh, Debashish, thank you all very much for your time today. Great hearing your thoughts, as always. Fingers crossed on the budget.
As market players remain confident of the revival in the investment cycle, let's hear it from policymakers. We spoke with the chairperson of the Parliamentary Standing Committee on Finance, Jayant Sinha. He says that we can expect a pacey, investment-driven and all-inclusive union budget to be announced by the Finance Minister on the 1st of February.
Today I have a very special guest with me, the chairperson of the Standing Committee on Finance in Parliament, Mr. Jayant Sinha, who also was the Minister of State for Finance and Civil Aviation a few years ago. Mr. Sinha, great pleasure to have you on the show with me, but thank you very much for joining in. Let me begin by asking you about the kind of recovery that we are seeing at this point in time, because most economists that I've spoken to agree that it's an uneven kind of a recovery. The popular term is to call it a K-shaped recovery. Is the government concerned about this uneven nature of the bounce back, and what can be done to address it?
Well, I think all of us are concerned, Udayan, about the recovery, and I think it has really 3 parts to it. Number one is the speed of the recovery, right? And of course, we want India's growth coming out of a once-in-a-century COVID pandemic to be definitely close to double digits this year, and then to continue forward at a robust 6, 7, 8% a year. So the speed of the recovery is, of course, very important. Second is the nature of the recovery, and we would like it to be investment-driven. Certainly, consumption will continue to play an important role in our economy, but investment is key. And that's why you'll see the government really emphasizing capital expenditure, emphasizing private sector investment, because investment really is the foundation for growth going forward. So investment-led, investment-driven is the second aspect of the recovery. And the third aspect of the recovery, obviously, is that it is applicable to everyone, so that it's not just restricted to a few, but that everybody gets the benefit of the recovery. And that's why you'll see that when it came again to the kinds of expenditure that the government has undertaken in the last year or two, those expenditures, while they have certainly targeted health and vulnerable populations, have also been focused on important aspects of the economy that have high multiplier effects. And that's why you've seen the National Infrastructure Pipeline, which obviously drives infrastructure. That's why you've seen the PLI schemes. You've seen ease of doing business getting lots of encouragement. So what we want to do is that as we come out of this COVID situation, that the recovery is fast, that the recovery is investment driven, and that the benefits of the recovery go to everyone, because we are stressing the high multiplier aspects of what can be done at this stage.
As you focus on these high multiplier areas on investment, would the government also pause to consider the plight of industry, specific sectors which have been actually scarred a lot more over the last couple of years? Areas like tourism, hospitality, aviation, retail, because we have seen a lot of credit impetus to MSMEs and sectors like that which were badly hit. But some sectors have been hit much worse than others. Should one expect the government's focus to turn to some of these beleaguered sectors?
The government's focus has been, Udayan, on these sectors that are touch intensive, that are high touch sectors, and where the restrictions associated with the pandemic have really made a tremendous sort of negative impact on their activities. And that's, of course, everything associated with, certainly personal services, certainly all of those that are related to travel and tourism, hospitality. And there, there's been concessional credit that's been provided through some of the credit schemes that are out there. There's been an effort to be able to provide support through various schemes and mechanisms where some relief can be provided. And of course, the liberalization and the streamlining of ease of doing business, all of these have been intended to assist some of these beleaguered sectors.
Now, you spoke about stoking investments, and that's clearly where the focus should lie. But what needs to be done, Mr. Sinha, to get India's investment to GDP ratio back up to those high 30s, which we had maybe a decade or more ago? But do you think it's only a matter of government trying to stoke it, or do you think certain ingredients have to fall into place? Because it seems to be getting stuck in the low 30s for the last many years.
Well, I don't think it's that easy to do a simple apples to apples comparison between what was happening about 20 years ago and now. The nature of investment itself has changed. There's a lot more leasing in the economy that's going on. For example, in the airline industry, you're leasing planes as opposed to buying planes. So that's changed qualitatively. The whole nature of the economy has become less capital intensive. People are getting more out of less. A lot of it has been digitized, where again, the investments are not that necessary, and you can get by with a lot less. So you really can't do an apples to apples comparison between what was happening 20 years ago and what is happening right now. What we really have to look at is GDP growth, which of course we think is going to be very strong going forward. You've got to look at job creation, which of course in the high productivity and the export oriented sectors is starting to boom quite quickly. And you have to look at the kind of money that we are attracting into investments, both domestically through, obviously the stock market and other forms of investment, as well as both private equity, venture capital flowing in from overseas, as well as money flowing into the capital markets, FPI flows. So if you look at investment flows right now, investment flows are at unprecedented levels. They've never been this high. And of course, government is investing in a very substantial way as well. And that's why this notion of investment-driven growth, I think, is really starting to emerge because of these big sort of investment flows that we are beginning to see.
You spoke about investment flows, so let me bounce off or tick off this one issue which I wanted to bring up with you, which is the issue of this capital gains tax waiver on bond transactions by foreign investors. Because it is one reason you will agree that India is not part of global bond indices. And the consensus view is that if India were to address this issue, we could get tens of billions of dollars coming into over the course of the next year or so, as India becomes part of those bond indices. Is that under consideration at the level of the government? And do you think we could have a resolution or decision on that soon?
So then I'm not a member of the government. I'm a member of the legislature. I'm a member of parliament. So what's going to happen in the budget, what the policies of the government are going to be, I think the government will address those. And they are, of course, best positioned to tell you about that. But of course, as you know, the government has been taking very substantial steps to open up our debt markets to enable global bond investors to come into India. We've attempted to remove the hurdles that are preventing us to being included in some of these important global bond indices. And all of these efforts are underway, and our companies have also been able to borrow quite intensively in capital markets overseas and raise ECB's external commercial borrowings. At the same time, of course, we always have to be careful about capital flows, particularly debt flows coming into India, because we want to be in a situation where we can balance it in terms of our own external borrowings as well. So like in many other things in government, there's a trade-off here between attracting bond inflows and making sure that our external account is in balance and is robust. So that's essentially the trade-off that has to be thought through. But I think the government is proceeding methodically and in a very comprehensive manner to addressing some of these challenges that bond investors have brought up.
Since we are talking about the issue of debt, I also want your thoughts on, as say the chairperson of the Standing Committee on Finance, because this is an issue which has come up, I presume, or I believe in discussions, the role of the Reserve Bank of India in the government's debt management. There is apparently a view that the RBI should be divested of that role. Where do you stand on that?
Well, then that debate, that discussion has been ongoing for a very long time. And again, like any one of these trade-offs that we talk about in government, this is another trade-off, because on the one hand, the RBI has a very clear mandate for price stability. They've been mandated to keep inflation between 2 to 6%, 4 plus minus 2. That's their explicit mandate. On the other hand, as the debt manager for the government, obviously they would like to keep rates at a level where the government can borrow comfortably. So that becomes a balancing act for the RBI. And there are many experts, economists, that have mentioned and advised the government that public debt management should not be part of the RBI's functioning, that it should become part of the government's activities, because the government is just one borrower. So the central government, in effect, is just one borrower among many other borrowers in the economy. And if you're just one borrower among many other in the economy, then the RBI should not be preferring the central government over other borrowers in the economy. So that is a strong view that many economists, many experts believe should prevail. And of course, as I said, there's been lots of debate and discussion about when and how to undertake the separation of these activities from the RBI, so that the RBI continues to follow through on its remit of maintaining price stability and letting the government become an independent borrower like other borrowers in the economy.
Staying on the subject of debt, Mr. Sinha, the one issue which keeps coming up in discussions is that the government plus state debt to GDP is now approaching 90%. I mean, while we are nowhere close to some Latin American countries and nobody's talking about a great implosion, but it is approaching a worrying level. Would you not agree?
I think the part that we really need to understand, Udayan, is what is the interest expense that we are incurring every year, and is that manageable? And of course, that's a function of interest rates as well. And that brings us back to the earlier discussion we were having of the RBI as a public debt manager and RBI as a monetary policy authority that has to set interest rates, right? So if inflation is going up, RBI, because of its mandate, will have to raise its rates. And as you do that, obviously, the government's borrowing cost also increases, right? Today, out of the 34 lakh crores, 35 lakh crores, that is government expenditure, 8 lakh crores, right? So out of the 35 lakh crores, which is the government's expenditure, 8 lakh crores is actually interest expense, right? And if inflation is going up, then the cost of borrowing also increases, and 8 lakh crores becomes a larger number because government's interest rates have also gone up. So that becomes a big burden on the budget. And that is the problem with debt to GDP increasing. The more debt to GDP increases, 8 lakh crores obviously goes up, rates also go up. And then we start to get in a situation where the government's ability to deliver public services and support the economy is constrained because we have such high interest expenses that we're bearing. And so that's why the 90% debt to GDP is a number we have to watch. I will also remind you, Udayan, that when the Finance Commission and other expert groups have looked at this topic, they have said that the right debt to GDP level should be at 60%. Right now, we've reached 90%, and that's largely happened because of the COVID pandemic, where we've had to spend a very significant amount of money and take our fiscal deficit from 3%, 3.5%, which is where it normally is, to 9.5% and 6.8%, and so on. That obviously is going to mean that the debt to GDP is going to increase. And the more that increases, the more rates go up, then the more pressure there is on government expenditure. Those are the dynamics, the debt dynamics that we have to be watchful of. And I'm sure that the Honorable Finance Minister, the Honorable Prime Minister, completely understand these debt dynamics and are going to be very prudent and thoughtful about what expenditures to incur as a result of that. And that's why it's even more important for us to have investment-led growth, which can drive sustainable growth in the long term, and that can then bring down the debt to GDP and reduce the pressure that government is facing on that account.
On this point, the government is not just the central government, it is also the combination of all or collection of all state governments. What are your thoughts on the nature of state finances post-pandemic? Because, we keep hearing that the states cribbing all the time that they're not getting enough of GST transfers, and one can clearly see that their finances are not in good shape. And it's not only the central government which can spur growth.
So that's not exactly true.
Yes, please go ahead.
So the state governments are doing much better than the central government in terms of their fiscal dynamics, in terms of their debt burden. We have, of course, provided them some relaxation because of the COVID pandemic. But essentially, all state governments under the FRBM, which is the Fiscal Responsibility Act, have to maintain their fiscal deficits at 3% of state GDP or lower. And they've typically maintained that. We've given them, as I said, some relief during the COVID pandemic. But even as we've allowed them to borrow more, because of the pandemic, they've actually not been able to spend that amount, right? So the deficits, which we thought would go up well beyond 3%, closer to 4%, actually are staying fairly close to 3%. So even as the central government has borrowed more and spent more and been able to spend more, states have not been able to do as much. And so the fiscal health of the states is actually at this stage significantly better than that of the central government, which has had to incur significant expenditures to get us through the COVID pandemic.
Let me turn to another issue, which is an important one, because you spoke about the credit cycle a while back. I want to ask you, as chairperson of the standing committee, about the Insolvency and Bankruptcy Code. Do you lean towards the view that needs to be resurrected because it is not delivering along the lines that was expected earlier, and we need modifications and tweaks for a new IBC code?
So then we have done extensive work on the Insolvency and Bankruptcy Code. I myself piloted that legislation in Parliament, in the Lok Sabha and the Rajya Sabha. So I have, of course, seen it from when it got started. And there have been many, many amendments since then. And we have also issued from the Standing Committee a very comprehensive report on the areas that need to improve. There isn't anything fundamentally wrong with the code. The code is actually a revolutionary, game-changing set of guidelines and laws for resolving bankruptcy. The most important thing at this stage is that the execution of it, the working of the code, has to be strengthened and to be expedited. And there we have still significant vacancies on the NCLT, on the various benches. We need more people to come in. We need to have more benches as well, because the volume of work has gone up and, of course, is going to continue to be high because of the COVID pandemic. And then we need to digitize and streamline the functioning, for which we have recommended many measures, so that the NCLT processes can move in an efficient manner. So that's the primary requirement right now. The legislation, the laws, the rule book, I think is quite comprehensive, is quite well established, but it has to be managed, it has to be implemented a lot better. Then there are 2 or 3 other areas where the insolvency processes need to be extended. One is on cross-border, and certainly there is work to be done there. The other is in the pre-packaged area for MSMEs as well. Again, there has to be some work done there. And then we have also recommended that the code of conduct for creditors needs to be strengthened and established as well. So there are areas where the legislation and the laws need to improve. But by and large, our biggest challenge right now is to just make sure that we execute it much, much better.
Now, I take your point about execution, but there are other wrinkles in the code which seem to be coming in the way. For example, I'll give you a couple of examples. One is the kind of haircuts which some of the lenders are forced to take. In the case of Videocon, which was a large settlement, I think the lenders lost about 95% of the original loans. The other issue is whether it is pragmatic to sell a large malfunctioning asset as one piece, or the value can only be realized by breaking it up into 4 or 5 different pieces and then selling them separately to separate buyers. These are not execution issues, these are fundamental issues. Would you agree that some of these need to be tweaked?
Well, then one of them is an execution issue. The other is one which requires some changes to the rule book. We have recommended changes on both those two dimensions that you've highlighted. As far as proceeds are concerned, so that you can recover more than you have been recovering in the past. We have said that execution has to be streamlined so that the asset value is not eroded so quickly. The longer the process drags on, the more there is an erosion of value. So we've said let the process be done very quickly so the erosion of value doesn't happen as much. Number two, we've said there has to be a code of conduct for creditors so that they can expedite and streamline this resolution process. And they shouldn't be of the view that as long as you've gotten past liquidation value, that's good enough. And third, we need to be thoughtful about what the benchmark should be. We are not prescribing a benchmark as such, but if the view is that the benchmark is liquidation value, which can be 10, 20 cents to the dollar, then that benchmark is not an appropriate benchmark. We need to do much, much better to be able to get value out of these proceedings. So on the first point, which is about what is the recovery? I think the recovery can be improved and made much, much higher if indeed these execution issues are addressed. Now, coming to your second question about being able to, sell a company in the insolvency process in different piece parts, we are in favor of that. There are certainly many companies that are conglomerates and have assets that will appeal to different kinds of buyers. And in those cases, the resolution professional and the insolvency process need to take that into account and proceed in that manner. Because ultimately, the goal that we are trying to achieve is a speedy resolution process with high recoveries. And so whatever can support that should definitely be considered.
Now, many of the lenders to these troubled companies, which you are trying to address, are public sector banks. And in the previous budget, the finance minister made a kind of a commitment or at least a wish that 2 public sector banks would be privatized. Stakes would be divested from the government. That has not happened in the last year. I want to ask you your independent view on whether you think public sector banks should be privatized, and B, what is coming in the way of being able to do these divestments in a very buoyant capital market scenario?
Well, then this question has been asked many times. It is the stated policy of the government of India that some public sector banks should indeed be privatized, right? And that, of course, is what was expressed in the budget also last time. What I think you can achieve through privatization is to make these public sector banks much, much more competitive and create much more value for the citizens of India who are the owners of these banks. So we really have to undertake a transformation of these public sector banks so that they can become more competitive, they can win in our economy and be able to compete with private sector players and other larger public sector banks. So we have to make our public sector banks, particularly the smaller ones, a lot more competitive, and privatization is a good mechanism for achieving that competitiveness. So that is the stated policy of the government of India that has been stated many, many times. And that is in fact what the Honorable Finance Minister is hoping to accomplish. Now, why that has not happened this year, it's difficult for me to say because, as I said, I'm not part of the government and we have not held hearings on this. as far as the standing committee is concerned. So it's hard to say that, but definitely that is the policy of the government of India.
Well, you were not part of the government right now, but you were not very long ago a Minister of State for Finance. So you must have some knowledge of these issues. Is it a banking union issue? Is there resistance from that front? Because, in a difficult market here, you can say that the conditions were not right. But this year, market conditions were so buoyant. There were billions of dollars of IPOs. The government could have slipped in one public sector bank at least. So I'm not asking for the specific instance of this. Given your knowledge of how these things work, why do you think it is taking so much time?
So then let me just speak on the basis of my own personal experience, because I was associated with the efforts, that went into IDBI Bank and of course Air India. So I know a little bit about how the disinvestment process proceeds within the government, and therefore what are the considerations. Now, why it has not happened could be due to any one of these considerations, but there are at least 4 or 5 considerations that you have to take into account when you go through the disinvestment process. One is, of course, you have to see what the state of the capital markets is in terms of valuations and whether those valuations are above your reserve valuation and so on. So valuation, state of the capital markets, that's one consideration. The second consideration, which is perhaps the most important consideration, though it's not discussed very often, is whether there are appropriate buyers on the other side, right? So even if you want to sell a government company, you need to make sure that there is a robust pool of buyers that's willing to buy that company as well, right? So you really have to take into account how deep and liquid that pool of buyers is before you can actually consummate and make some of these transactions happen. So that's a second very important consideration. The third very important consideration is that there are very often many liabilities, issues that have to be sorted out. In the case of Air India, we had a whole host of non-core assets like real estate, like subsidiaries, hotel companies that Air India owned and so on. And so we had to find a way to get those non-core assets out of the core operating assets of the company, which is what we did with an SPV structure. And that enabled us to be able to move forward as far as that disinvestment was concerned. Then there is a fourth consideration, which is the debt that a company has. Again, in the case of Air India had 66,000 crores worth of debt also on its books. So we had to find a way of resolving those debts as well, along with the non-core assets. And then finally, there are, of course, a whole host of workforce issues, including, for example, the union issues that you mentioned. There has to be a fair resolution of those workforce issues in terms of healthcare benefits, pension benefits, employment considerations, and so on. And it's only when you establish a consensus on those workforce issues that you can move forward. So all these are important considerations that have to fall into place to be able to make a transaction happen. Now, which of these, has been part of what the government has been considering for these public sector banks, I can't say. But typically, these are the 4 or 5 issues that you have to resolve before you can undertake a transaction.
Okay, my last question to you is about the cryptocurrency bill. I mean, I don't know whether it's coming in this budget session, but which way do your thoughts lean on the kind of bill and laws India must have to regulate cryptocurrencies on 2 broad parameters? One, of course, on whether it should be legal tender or just an investment class or asset, and B, whether it should have capital gains taxation laws like equities, or you prefer or you would advise another kind of taxation.
So then you're asking me very specific questions about cryptocurrency. Let me first of all clarify again that I don't represent the government because the government has to take its view on these matters. That has to be reflected in the cryptocurrency bill that gets tabled in Parliament. When that's going to be tabled is a decision the government is going to make. So that's one set of perspectives. The second set of perspectives are those of the standing committee, and those perspectives have not yet been developed because we just did one hearing. And then, of course, we decided let's wait for what the government tables in Parliament. And then on the basis of that, the committee can formulate its own opinions, right? So that is also a process that is underway, and that will happen in a productive fashion only once the government tables its crypto bill in Parliament, and then we can form an opinion on that as a committee. Then there's a third set of perspectives, which is my own personal perspectives for whatever they are worth. And as far as my own personal perspectives are concerned, I think it's very important at this stage that there be a global consensus on how crypto assets should be considered, or crypto tokens should be considered. We have in India a particular challenge, which is that we have capital controls, which many other jurisdictions don't have. So first, I think we have to wait for what the global consensus is and how these crypto tokens should be considered. And Singapore, Japan, the UK, many of them have formulated a view where they're largely being considered like an asset. The US still has not, decided how it's going to be considered. I think this is something that should be taken up through the G20 process, through the Bank of International Settlements, and there has to be a global consensus that gets created on how to think about these assets. Then, we have to bring into it the capital controls that we have in India, and we have to figure out technically how we can make those capital controls work. Because right now, with the decentralized nature of cryptocurrencies, capital can flow freely across jurisdictions, across boundaries. And so unless we technically work out exactly how we are going to implement our capital controls, it's not clear how India can establish a proper regulatory framework. But in all of these cases, then there has to be a balance between innovation, which definitely decentralized finance and crypto assets, crypto tokens, cryptocurrencies represent, and regulation, which is there to, of course, protect. Personally, I would say that I think it's possible for us to enable this to be a viable and well-regulated asset class. I think it's entirely feasible. But for that, India will have to take some very interesting and novel steps as far as the technical aspects of it are concerned, so that we can, in fact, maintain our capital controls. That will require significant innovation, which we are very capable of, but it will require significant innovation that's very different from what Japan is doing, Singapore is doing, UK is doing, US is doing, because all of those have open capital flows. And so they don't need to apply the kind of controls we need to apply. So those will require some technical innovations. People have come up with some ideas around that, but that is going to be necessary for us to make it into a well-regulated asset class where people can invest in confidence. Sorry for that long answer. I'm not sure then whether that is what you were expecting.
No, that is exactly the kind of clarity I was expecting, and thank you very much for that, as indeed for your time today, Jayant Sinha. It's been a pleasure talking to you. Thank you very much.
Thank you, Udayan.
BTTV's managing editor Siddharth Zarabi sits down with Minister of State, Electronics and IT, Rajiv Chandrasekhar. He takes us through the future roadmap of semiconductors in India. We've already seen a big announcement, a 76,000 crore rupee PLI scheme. What more is on the cards for the space? Listen in.
My guest today is a person who started his working life as a semiconductor chip designer. Before going on to bring the power of connectivity to Indians, setting up one of the earliest mobile networks in India in the 90s. He followed up and entered politics in 2006 and has been in the Rajya Sabha ever since. Last July, he was appointed as the Union Minister of State for Electronics and Information Technology, as well as Skill Development and Entrepreneurship in Prime Minister Narendra Modi's Council of Ministers. Welcome to the show, Rajiv Chandrasekhar. It gives me a great pleasure to have you with us today on Business Today. I'm going to start this conversation around what I term as semiconductor nation. India is a startup nation, but your government is also now looking at semiconductor nation. And to put it in context for all our viewers, many people don't realize, in fact, most may not realize that one of the negative consequences of the COVID-19 pandemic has been this great semiconductor shortage globally. And it has meant that ordinary Indians are facing delays of months for their most preferred car. They're facing delays for their handsets, and industry is also complaining about other shortages. This is something that you know, not just as a minister, but as a professional. I'm going to request you to start by telling us, when do you think this shortage will abate, and in the near term, are there any alternatives that are available?
Siddharth, thank you for having me on the show, and thank you for that question. I think one of the things that the COVID has taught almost every nation and every business in the world is that there has been an extraordinary amount of concentration of the global value chains of electronics and semiconductors around China. And it is clear that in the post-COVID world, there is a desire for the world's economies to seek a broader diversification of this global value chain. But during COVID and even now, one of the consequences of this extraordinary amount of concentration of electronics and semiconductors in this region, and a consequence also of the deep disruptions in the supply chains because of COVID, has been that almost every sector and every segment of the industry that relies on semiconductors, whether that be a car producer in the US or Japan or a infotech hardware producer in Korea and other parts of the world, all of them have been deeply impacted by the shortages of the semiconductors, as well as the disruptions of the supply chains for those semiconductors and electronics, or a combination of both. Now, that is something, as you know, the COVID has disrupted many things, including lives, livelihoods. This is again one more of those things that COVID has deeply disrupted and impacted. And to your question about when will this ease, I think there is certainly an additional capacity that is being built all around the world on semiconductors and electronics. In the short term, I think it will ease in the next probably 3 to 6 months in the short term, but the actual sustainable resilience of the semiconductor value chain, on the electronics value chain, in my opinion, will play itself out over the next 1 or 2 years as manufacturers diversify and expand to other geographies apart from China and China proximal geographies.
Rajiv, many of our viewers may not remember, but you are one of those Indians who have worked in the semiconductor industry, and you were handpicked by the legendary Vinod Dham on the earliest version of the Pentium chip. So this is a subject that you know more than any other person in all of India's politics. I want to ask you, why has India failed to develop a semiconductor manufacturing base, despite having a head start in the 70s and 80s with one of the most advanced wafer fabs in Mohali of all places, and then a lot of things happened? Why did we lose the semiconductor opportunity?
Look, I think this will require a totally separate program to go into this. I think it's a question that is worth asking, but the answer is is very simple, Siddharth. It is that I think successive governments have lacked the vision and or the capability to create an electronics manufacturing ecosystem, to sustain it, to grow it, and really seize the opportunity that was available 20, 30 years ago when the world was seeking to diversify from the Western economies into Asia, the electronics value chain. And at that point, India was either asleep at the wheel, or the political leadership of that time did not pay enough attention to it. And leading up to 2014, Siddharth, the facts are there for every Indian to see. The electronics and indeed the entire manufacturing ecosystem in India was devastated by these reckless FTAs and mindless, badly negotiated FTAs that India had entered into. It is only after 2014 that the Prime Minister had this determination and this vision that we will create an electronics ecosystem. And as you know, that in the 2014 timeframe, we were about 1 lakh crores in electronics manufacturing in India. And today we are 5 lakh crores. And it has taken serious policy making, serious execution capabilities on part of this government to expand the electronics ecosystem. And why I talk about the electronics ecosystem is no country worth its name who wants to be a player in technology, wants to be a player in or a participant in the semiconductor ecosystem, can do so without an electronics ecosystem. And in India, pre-2014, there was very like a nothing to talk about electronics ecosystem. Now we have a situation where we are exporting mobile phones to global markets. We have, we are now have an ambition of $300 billion of electronics by 2025, 2026, out of which 120 billion will be exported electronics. So we have a growth path for electronics. It seems now it is absolutely natural and it is absolutely the right time for India to play out its semiconductor ambition and to build this. And again, here it is the Prime Minister's Digital India vision, the vision for electronics, and his tremendously supportive policy making of 76,000 crores of capital being invested by the government of India into building an electronics and semiconductor ecosystem that is going to make India's moves today far more credible and far more real, able to succeed than any time in the history of independent India. Like I said, I don't want to dwell too much, Siddharth, on why we could not do this before. We should have, we could have, we must have. All of that remains a thing that we will look back at as missed opportunities. But that is, in a lot of ways, Prime Minister Modi's government is addressing on a daily basis mistakes that have been made in the past, opportunities that have been lost in the past. We are trying to make up for all of those mistakes in the past by doing the right thing today.
Rajiv, before I get you to talk more about the semiconductor policy and explain that for the common man, for the common viewer, I also want to tell our viewers that there is Silicon Valley folklore about two mafias in the semiconductor industry. One was the Indian mafia and the other was the Iranian mafia. And you have a string of names who have actually built the semiconductor industry in the United States. What gives you the confidence that the current policy framework that you just spoke about, the 76,000 crore package, it will succeed this time? I ask you this because previous attempts in for example 2017 or thereabouts with 2-3 companies have not succeeded. What gives you the confidence that it will work now?
First of all, there is a total reset in my opinion, and I say this with you will say that I'm saying this because I'm a minister, I'm from the BJP, but I mean this sincerely. There is a total reset in the perception about India and its capabilities amongst the Western tech world or the tech ecosystem. And that has been reinforced by India's performance during COVID. To a large degree, India has earned a tremendous amount of awe and respect in the way our economy has rebounded during COVID, in the way technology has been used in the last 6 years that has allowed for this mass scale vaccination at a level and scale that even the world is not able to comprehend, and they are in awe. And today the world looks at India in very, very different terms. It is not an India which is an India just of potential. The narrative of India for many, many decades, Siddharth, was we are a great country, we have a large population, and we have a great market, and therefore with great potential. And we did that with the IT services space, and we did, grew a lot. But where we missed out for several years was in deep tech, in electronics, in semiconductor. And today, the world looks at India, and I say this because I interact with all of the world's leading majors in terms of companies. And they look at India and India's ambitions being backed by an execution capability and an execution record by this government that is very credible. It is one thing to dream. It is the other thing to have dreams that are backed by people who are able to realize those dreams into reality. And the government of India today, and India particularly, is seen today as a country that not only is dreaming big, but also has the ability in government, its startups, its entrepreneurs, as having the ability to realize those dreams and make it a reality. Look, today, when the Honorable Prime Minister talks with such a lot of affection and respect for our startups and talks about 2 unicorns every month. It is something that is absolutely astonishing to the rest of the world that we are creating one of the world's largest sustainably growing startup ecosystems.
Right.
So in the tech space, Siddharth, in a nutshell, the world sees India as a leading player in technology. And as the world, the new normal of the world is increasing digitization of the world, Web 3.0, Industry 4.0, and all of those things that are going to continue to disrupt and change the new normals. Everybody realizes that India and Indian entrepreneurs and Indian talent are going to be part of the leadership of this global technology drive. And therefore, that credibility and respect for India is there today. So today, when the global semiconductor majors engage with India, it is no longer with skepticism. It is with absolute serious, earnest interest in understanding our mission, our policies, and our goals for electronics and semiconductor and technology in general.
Rajiv, since you speak about that and how global semiconductor companies are talking with seriousness with the government, I have to ask you, is Intel coming to India to set up a fab?
It will be my fondest dream, and I'm sure for every Indian, if any of these large semiconductor companies today who bring to the table technology, research, manufacturing know-how and capability, look at India as a partner. There is TSMC, there is Intel, there is Global Foundries, there is Samsung, there's NXP, there's Infineon. There are so many companies in the world that are all either straddling a niche in semiconductors or straddling a broad amount of technology and capabilities in semiconductors. We are today open to partner with any of them or all of them. And I think given the fact that we are going to be a leading player in the electronics value chain, as the Honorable Prime Minister himself said at the World Economic Forum, given those ambitions are out there for the world to see, given the fact that the government has a very, very pragmatic policies for semiconductor investments in this country, and given that the world today is looking at diversifying and diversifying its supply chains in semiconductor, I think India is a very, very attractive opportunity for investment and partnering for all of the global majors. And I want to add one other thing here. The future of semiconductors and computing and communication in particular, Siddharth, is moving from semiconductor intensity and manufacturing intensity to a regime where there will be a hybrid of manufacturing and design innovation that is going to drive computing performance. And that is exactly the sweet spot at which India is positioned. We have tremendous amount of depth and capability in semiconductor design, system design innovation, and that is playing to our strength. So my pitch to every one of these Indian international majors is, the future is exactly a combination of many things intersecting, and India is sitting right at the intersection of all of these changes. The talent that India has, the capabilities that Indian youth and entrepreneurs have, plays to what the future of technology will be. And I think it is the smart thing for most of these companies to do, to evaluate India as a partner to invest in and build the next generation of semiconductors.
Just last year, Intel announced that it would invest around $7 billion in Malaysia for a semiconductor chip packaging factory and create 9,000 jobs. Since we've been working on the policy for quite some time, I just want to ask you, why didn't Intel, for example, choose to do that in India? We have an ecosystem that would have perhaps given it that chance to invest in our country.
No, Siddharth, I mean, this is a question to which I don't have an answer. Obviously, why has no company invested in Indian semiconductors? Why pre-2014 did we not have an electronics industry to talk about? These are all things that we will talk to our grandchildren about one day and say these are the missed opportunities for India. But that is what Prime Minister Narendra Modi ji is doing. He is trying to make up for lost time and missed opportunities and really focus the country and focus the nation by working with the state governments, working with industry, to ensure that these opportunities in these coming years and coming decades, and he said it beautifully yesterday in the World Economic Forum, that his visioning and his planning is for the next 25 years. Even as we celebrate 75 years of independence, we have a government and a leadership that is focused on thinking about the India when it turns 100 years of independent nation. So a lot of this is about the ability for political leadership to think of the future, which in my opinion, frankly, was not there in the past. We today have that, fortunately. And I think that is the direction that we have to go. That is the direction we will go. And it's. I always say, don't look back too much and don't worry about the rearview mirror about how many kilometers we traveled without achieving anything. And that's probably true. We should just focus on the windscreen in front and focus on bringing these majors to India, creating an ecosystem of innovation, design, and manufacture for both semiconductors and electronics. India has a tremendous opportunity to be a player in this and a leading player in the global value chains of global electronics and semiconductors. And we should realize that and make it a real opportunity, make that opportunity a real one.
Fair point, Rajiv. And in fact, it's not just the foreign companies who are interested. We've already had some amount of news flow, for example, the Vedanta Group saying that it wants to invest over $15 billion in the next 5-10 years to make display and semiconductor chips in India. The Tata Group is said to be looking for land in Tamil Nadu, Karnataka and Telangana. There have been a couple of other Indian consortiums. For our viewers, when do you think any of this will actually fructify? I take your point that you cannot speak about a particular company's plan, but generally, when do you expect this to actually get affected on the ground?
You know that I'm not a great crystal ball gazer, and I just believe in following the lead of our Prime Minister, which is work for the today and the tomorrow will play itself out. So we are working hard in essentially creating the policy framework. We are advocating that policy to every player in the semiconductor and electronic space that is interested in India, and we are making even those who are uninterested in India aware of this opportunity and get interested in India. I think it's a very good thing that Indian companies are also taking the lead. I have urged a lot of the large tech companies who are traditional tech services companies. I've urged them, look, you are large, big global leaders in tech. One of the new elements of the digital economy is electronics and semiconductor. You must get into that. So I'm actually pleased that there are Indian companies that are also joining the fray, collaborating, tying up with those who have the requisite technologies and looking to invest. We will continue to be supportive of both foreign investments and Indian entrepreneurship and Indian startups and Indian companies. So I think we will see over the next 3 to 6 months how the policy plays out, how our advocacy efforts play out. I am reasonably confident that India in its destiny has in it to becoming a leading power, a leading hub for electronics manufacture, semiconductor manufacture, design, and the whole innovation ecosystem. So I'm deeply hopeful and confident.
As I ask you the next question, just to tell our viewer that the manpower and the intellectual sort of firepower that Indians have in the semiconductor industry cannot be underestimated. By one reckoning, there are well over 25,000 top-notch designers, chip designers and other engineers associated with this field who are working. We of course have a large import dependence. Again, one number states that we are annually importing close to $25 billion of semiconductors, and therefore that makes sense for an Indian investment. Rajiv, also tell our viewers about this plan to revive the Semiconductor Complex Limited, and there's a small story which I'm sure you are aware of. This was a PSU being set up in the 70s and 80s, and there was competition between Maharashtra and Punjab who gets to set up the plant, and I'm told that Punjab ultimately got it because the land was offered for 1 rupee. That plant then got burnt. There is an entire conspiracy theory around it. It was a state-of-the-art plant. Then it went to the Department of Space, and now you have decided to revive it. Tell our viewers about the plans that you have for it, because it was an icon in Mohali and gave great pride to people of Punjab for many decades.
Let me first respond to your point about talent and skilling, Siddharth. And as you correctly said, the world semiconductor ecosystem around the world is full of great Indians and Indian success stories, whether they are in design, whether they are in manufacturing. You mentioned Vindham, you mentioned, there are so many very bright, talented Indians that are in leaders in the semiconductor space that I believe that in some sense we are preordained to be a player in the semiconductor space. In terms of skilling and semiconductor research, it is an area where our academic ecosystem has lagged, and that is natural because there was no room for semiconductor research and semiconductor design skills at that level. But it is an area that we are very focused on. We have a roadmap where we will have very soon a large number of very skilled, highly capable, excellently skilled talent in semiconductor design and even semiconductor research. So that is something that we are working in the ministry with the AICTE, with the Ministry of Education, and creating that, in a sense, pipeline of talent that will fuel our Indian semiconductor innovation ecosystem. In terms of the SCL, I remember in the early 90s when I had just come back from the US, I remember at that point looking at SCL and wondering why it was not doing more. And then all those stories about fires and conspiracies and whether there was a deliberate attempt to scuttle India's semiconductor ambitions and semiconductor growth. Anyway, those are conspiracy theories for which I don't have an answer. But I do have an answer to your question about what will be the future of SCL. I think SCL has a tremendous amount of capabilities. It has a tremendous amount of capabilities in terms of human resources. It has a basic capability and process right now that it has of manufacturing semiconductors. It has been, as you correctly said, it has been under the Department of Space, doing work for the space missions and the ISRO's requirements. METI will work on, hopefully after the government reorganizes the ministries and the rules of business around it, we will draw up a perspective plan to grow SCL. And I will not say anything more today, but I think, except to say that SCL will be a very important component of the ecosystem of semiconductor design, manufacture, and innovation and research that the government of India under Prime Minister Modi wants to build. So it will be an important component, and we will roll out the plan and reveal the plan as that plan gets finalized.
Before I let you go, Rajiv, one last question, and this is in context of you talking about all the global majors and the Indian companies who are also looking at this space, and we hope that those plans fructify. There's one issue that's dominating headlines, and which is not semiconductors but a related space. This is electric vehicles and Tesla and Elon Musk's recent tweet saying that he's facing challenges in India, and it's sort of led to a lot of opinion being generated on that tweet. The government has also said that it is clear that it will not offer duty cuts. It instead wants manufacturing in India. Where do you stand on that as a minister in the Modi Council, sir?
No, so I think the government of India has spoken on that. I will not add to that. But I will speak broadly on the EV space. I believe, given where we are on electronics and our ambitions and our goals for semiconductors, as you know, EV is a very semiconductor and electronics and tech intensive product and platform. I think India and Indian entrepreneurs, there are so many, I've met many of them, very bright startups that are in the EV space, in the battery space, in the energy space, in the AI space. So I think this is an area that India will take a lead in, and India is going to be playing a bigger role for in terms of the global evolution of the EV segment. Apart from that, I don't want to speak to the controversy or the issues with Tesla. We respect Elon Musk everybody does. Anybody who has a slightest hint or connection to the tech space has the greatest respect and regard for him. But India is totally committed to an Atmanirbhar Bharat approach towards electronics and technology. We don't want just things to be imported. If it can be manufactured, it can be designed, and an ecosystem for that can be built in India. So I would encourage Tesla and Elon Musk to explore India as a partner in not just selling a platform, but also in design, development, and manufacturing that state-of-the-art EV platform.
Absolutely. Rajiv Chandrasekhar, I'm going to thank you for your time with us today and wish you all the very best and the government for its plans to convert India into a semiconductor nation. Thank you very much for your time, for speaking with Business Today.
There's been a lot of discussion about India's growth story and the increasing divide between the organized and unorganized sector. We take a deep dive into these issues with none other than Kaushik Basu, in conversation with our global business editor, Udayan Mukherjee.
The countdown to Budget 2022 has begun, and it's a good time to examine the state of the post-COVID Indian economy and what the government needs to do to stimulate the economy, particularly the lower end of the pyramid. My first guest in this series today has a very unique global and local perspective, because not only is he a distinguished professor of economics at Cornell University and a former chief economist of the World Bank, but he was also chief economist of the Government of India, chief economic advisor of the Government of India back in 2009. So it gives me great pleasure to welcome Dr. Kaushik Basu to this show. Kaushik, wonderful to have you on the show, and a very warm welcome.
Thank you very much, Udayan. My pleasure to be talking to you.
Thank you. Well, as I said, a good starting point for the series would be to examine where the Indian economy is today post-COVID, because the assessment of it differs depending on who you are. Some think it's a robust and sustainable recovery. Some believe it's quite fragile. What do you think? Is it a strong rebound, or do you think it's an uneven one, even bordering on fragile?
Udayan, see, the rebound is pretty strong, 9.2%. But, so it's not the fragility of it. What is important to understand is that India had dropped down quite a bit. 7.3% was the negative growth last year. So a large part of the sharp growth, and it is a genuine sharp growth, is from that bottom of the pit. So what is worrying is the following. India dropped more than most other countries. The pandemic management probably caused it. The pandemic was there. So all over the world, GDPs were dropping. India's dropped more than in other countries, perhaps to do with the management. We will come back to those details. Now, if you take the bounce back and then flatten it over 2 years, with the Government of India data, India's GDP growth over 2 years has been 0.6% per annum. India's population is growing at roughly 1.2% per annum or 1.1% per annum, which means once you put these two together, India's GDP per capita is actually shrinking over the last 2 years. The average growth is about minus 0.5%, a tiny shrinkage taking place. On top of that, and this is all not fragility, but the nature of the growth. The top end of India is doing pretty well. All kinds of data coming out from Oxfam, even Government of India data, if you look carefully. If you're reasonably well off in India, you're not doing badly at all. But the bottom segment is doing badly from all accounts. So where the problem lies is that if you're in the bottom half of India, the modern terminology of this is a K-shaped recovery. The top end is going up, the bottom is coming down. That in India is very, very marked. So overall growth for the per capita GDP is slightly negative over 2 years, Government of India data. Bottom doing worse than the top, which is growing. The top is actually becoming better off per capita, which means for the bottom segment, it is a very difficult situation. And it's not all to do with the pandemic. The pandemic has caused it. But in India, from 2016, every year's growth has been less than the previous year's growth, which has not happened in India ever since 1947. A 5-year run where each year is lower than the previous year. Last year, of course, now it's picking up. But before that, the stretch of 5 years is each year doing worse. So all this has caused a situation where overall growth, even if it has become sustainable, and really India has the strength, we can go back to that, it is a pretty grim situation for the workers, for the farmers, for even the middle classes, because it's a K-shaped recovery, very, very marked.
Right. I just want to take you back to those years of 2016 to 19, because you make a very important point that this is not all to do with the pandemic. So if I take you back to that and ask if the downward trajectory of the economic curve, growth curve, which we were experiencing between 2016 till the pandemic struck, a lot of people believe that maybe that we have snapped out of that. And this year onwards, while the growth will actually optically come down once the base effect goes away, we will refine the kind of trajectory that we had pre-2016. Do you agree with that assessment that India has actually refound its growth trajectory pre-2016, or the average growth of the next few years will be no more than 5.5% or 5 to 6%?
I don't think we have snapped back out of it. And let me try to explain a little bit. There's one segment you have to remember in India's GDP growth calculation. We calculate our formal sector pretty well. India's statistics are very good. What you do about the informal sector is you take the growth rate of the formal sector, you attribute the same growth rate to the informal sector. What we do know is that from 2016, the informal sector has been shrinking very rapidly like never before. So some of this attribution, which is done in good faith, and we've done this for a long time, the formal sector being attributed to the informal sector, that is not working. So, and there's another thing happening where even if it's a rebound, it's not the kind of story which India was facing. And I should go back right up to say 2003. There were indicators that India was beginning to do well. India's investment rate was picking up then. And as you know, by 2007-8, India was a global story. It was a question of whether it'll be India in the lead or China. India's nowhere near that scene anymore. We can still get there because India has fundamental strength, but let me point to one thing which has happened and is probably contributing to this overall not quite back there scenario. Investment as a part of GDP. If you look at the total amount of the GDP that is being invested, India was climbing. From 2003, India began to improve. By 2008, 39% of India's GDP was investment. And that was up to 2011. 2011-12, I remember the number, again, 39% of GDP is investment. India is beginning to look like an East Asian economy, and the global conversation on India is extremely buoyant. Where is investment, which was at 39%? It's now at 32%. And this is not a stock market indicator which fluctuates. 39 to 32 is a pretty steady downward journey. Investment is the central force of an economy's growth. We've done poorly on that. So yes, we will bounce back reasonably. India has enough strength. But right now, there is no reason to believe that we are going to get where the story was really a very, very positive story on India. We are not seeing signs of that as yet, unfortunately.
You also spoke about the K-shaped recovery. Now, I want to ask you, if you were sitting in the finance minister chair, there are two ways to look at it. One is to look at what is going on with corporate earnings, corporate growth, because the organized sector is clearly gaining at the expense of the unorganized sector. The formal economy, in your words, is growing at the expense of the informal economy, partly by design, it seems. But is that an acceptable trade-off in a country like India in your eyes? Or in the finance minister's chair, you would worry more about what's happening with the micro and small medium enterprises, what's happening with the informal end of it? Because in sheer numbers, that's a very, very large number of people. What can you do to alleviate that problem?
Yes, so it's part of it maybe by design, but in that case, the design is wrong. And this needs to be understood because it is true, it's good to have the organized sector growing. And India is doing somewhat better in the organized sector. But It is not the case that the unorganized sector labor is being absorbed here. This is a relatively capital-intensive sector, the organized sector. And all the data that we are getting on unemployment situation indicates that this sector is not being absorbed. The organized sector is growing, but the unorganized sector is not being absorbed here. It's being left to mind its own business. And if you look at unemployment, really, this is something that I want to stress, because I do want the people who are taking decisions now to begin to pay attention to this. India's youth unemployment is 24%. Just to give you a sense of comparison, for Bangladesh, it is 12%. For Malaysia, it is 11%. India, 24%. This is not where India was meant to be. India has always done worse than other countries in terms of youth unemployment. I don't want to exaggerate that, but it's steadily worsened and now at 24%. If you look at overall unemployment, latest government data is 7.9%. It had to be higher. All over the world, unemployment has risen. But 7.9%, Bangladesh, after the rise, is at 5.6%. So our workers are not being absorbed, and this is a matter of concern. And it's the infrastructure investment which can employ them. Let me give you one which is, people will make it out to be a political topic, but it's not a political topic. The kinds of things that we should do. Investment to absorb labor is important. But right now, since there is inflation, the investment ought to be in productive investment. One which does jar me, I have to say, the Central Vista project in the middle of this situation. And I'm not talking about whether it is worthwhile or not, that's another debate. And a project like this, if the economy is in a buoyant state, you want to do it. But right now, when there is so much suffering among the working classes, this project, I think, is wrong. It's about $2 billion over 4 years. This money could have been spent on other things. And over here, it'll be pointed out that it's creating employment. And it is true. There are estimates that something like 10,000 people are being employed. But see, this is why economics is fascinating and difficult. It intertwines with Keynesian policy. Keynes would say that you, during a depression, just create jobs, do anything. And to that extent, this may look fine. You're creating jobs. But this is not the usual Keynesian depression. This is a recession coming with inflation. So if you employ people and give them money, but not produce worthwhile goods, then it's going to fuel inflation. For that reason, the expenditure right now ought to be entirely focused. I would say for Nirmala Sitharaman, right now, the aim should be focus it all on productive investment, where more output comes out, because otherwise, if you just create jobs and have unproductive investment, you're going to fuel the inflation, which is already high. So it is a policy to counter the recession, but not a Keynesian recession where there is deflation. We currently have a recession with inflation, and that leads to subtle differences in policy making, which government of India has enough expertise for people to work this out and take this forward.
What is the extent of support you think is required for the lower end of the pyramid that you alluded to? Do you think there should be substantial government investment in some kind of a growth stimulus? Because the trade-off is, what should one do with the fiscal deficit? I mean, that's what the budget is about at the end of the day. Because we've strayed away from the path of fiscal discipline because of COVID. This year is since tax revenues have seen quite a bit of buoyancy, the big question for the finance ministry is whether to get back to the path of fiscal discipline or to give it one more year of elbow room and to try and use this money for some kind of a growth stimulus. If you were in her shoes, what would you choose? What would you opt for?
Yeah, Udayan, see, the revenue part has improved, and that the government deserves credit. It's improving. The GST collection has improved, so there is money in hand. What I would do at this point of time, however, is I would not rush for fiscal discipline, simply because the employment situation for the worst off people, for the farmers, for the workers, for small businesses across the board, it's a very, very difficult time. Barring the people who are at the top end, for India, it's a very difficult time. So what should the finance ministry do? Right now, don't go gung-ho on controlling fiscal deficit. let the fiscal deficit, yes, you can't let it go crazy. It'll be difficult to manage, but don't be overzealous about cutting down fiscal deficit. The inflation control, which is the fear if your fiscal deficit is large, leave it largely to the central bank. Reserve Bank of India in India, fortunately, is a very professional body. Leave them with the task of inflation management. You worry about creating jobs. So what you need to do is a large part of this expenditure, the deficit will be still moderately high, but the expenditure has to be flawlessly on productive employment creation. For that, part of it is the direct responsibility of the government. But a part of it is also the government should support and help small businesses, the private sector, but the small private sector, who will then create the jobs where these workers will be pulled in. With all this, there is one more thing I may point out, is just like infrastructure. Infrastructure, by the way, India has not done too badly. The infrastructural investment has picked up a little bit. But there are two bedrocks for the market economy. The infrastructure, the physical infrastructure, there is some improvement over there. But there is something else, which is economists don't often talk about, though nowadays modern economists have begun talking about. Trust in society is a very invisible kind of trait, but it makes a difference. There are cross-country studies showing that the Scandinavian countries do well because they have trust among themselves, higher than in other countries. This has nothing to do with a race or a region, because East Asian countries now have trust levels comparable to Scandinavian countries and do well. India, there has been a trust erosion, and there are informal studies showing that trust has gone down, society has become polarized. I don't know who is to blame, but it is for the government to try to pull it all in together and develop trust, because investment depends on many things, but one of them is trust. It's a very difficult thing to quantify, though there are studies from Israel. There are beautiful studies in laboratory. If you have a group that trusts one another playing a game, that group begins to become richer, the group that trusts one another. And a group that does not trust one another becomes poorer, and these are controlled lab experiments. Extremely important. So overall, and this is, I'm not saying that this is Nirmala Sitharaman's job, because this is a larger task for the government. The government has to pay attention to that. What she has to pay attention right now is, don't worry excessively about the fiscal deficit. Let it be a bit higher for a while. Let the Reserve Bank of India do the inflation control, but make your expenditure entirely focused on productive jobs, job creation, so that output is growing. You're not just creating jobs with no output, which is going to fuel inflation, which is also at a very dangerous point in India.
The other thing which she would be weighing in terms of options, Kaushik, is this whole thing between investment and consumption stimulation. Because there is one school of thought which is saying that since incomes have suffered so much at the lower end of the spectrum, there needs to be some kind of consumption support, which, I mean, through any means, some direct benefit transfer, taxation policy, etc. Do you think some of our focus should lie with towards consumption, or would you say 100% towards investment and job creation?
No, quite a bit towards consumption you can't avoid, because I feel we are underestimating the suffering of the bottom half of India. All piecemeal data coming in shows that, and there are some global studies now which are showing that poverty in India is increasing more than in other parts. So India's overall growth is hiding the fact that the bottom segment is doing very, very poorly, not to be taken lightly. For that reason, you have to directly support the poor with money, but also with support which makes the small private sector, the small businesses, begin to grow once again, so that they absorb some of the labor. Everything can't be done by the government absorbing the labor. So that's the way in which her expenditure ought to be. Support some consumption. Right now, the suffering is far too great not to do that. But yes, also begin to pay attention to production. What you must not do is expenditure where you create jobs and there is no production meant for consumption. Because that is right now, at this point of time, it is a glaring mistake to do that. It is globally visible. It's embarrassing to spend money on things which are not producing consumables, where there is so much suffering right now that is taking place.
Let me spend a minute on government's resource mobilization, Kaushik. Because while there has been some buoyancy in tax revenues, the government has not done very well on raising any kind of capital revenues through areas like disinvestment or public sector enterprises. But of course, recently there's been a grand announcement of a very aggressive asset monetization plan of assets owned by the government of India. And how important is it that the government gets aggressive and actually becomes competent in selling some of these assets? Because the government's debt to GDP is approaching 90%. I mean, very soon we will be needing to raise considerable resources to be able to spend along the lines that you are speaking about.
See, the debt to GDP ratio, I'm glad you brought this up. The conventional view was that you're comfortable if it is around 60%. You don't want it to go much higher than that. And for a long time, India was used to 65%, inching towards 70%. 90% is actually very, very dangerous. And this is dangerous for the following reason, that with debt to GDP ratio, it's something that happens under the carpet. You don't feel it in everyday life. But when things begin to go wrong, and we've seen this happen even in European countries, when debt to GDP ratio is high and things begin to go wrong, it unwinds very, very rapidly. For the government to bring in money and some of its government's excessive, useless assets to be sold is a good idea. But this has to be done arm's length. It has to be a very, very professional body that is brought in. And you're not fueling crony capitalism by selling it all to a few big businesses. India mercifully, unlike, for instance, historically growing up, used to hear in Pakistan about 22 families owning everything. India mercifully was not like that. We don't want to get into that where everything is being sold to a few big companies. So this has to be done very, very professionally. And there is no getting away from the fact that the government also plays a big role. You know, my own view, if I may give you my broad ideological view, is that in countries, governments ought to be small, but there has to be taxation of the top income and transfer of money to the bottom. So the government's role should be a quick transfer, and then don't get into every activity trying to manage and run every activity. Do keep a cap on the highest income and the bottom income, but don't get involved in that. And monetization of some of this can be done in exactly in that spirit. We want to be small, but we want to affect a transfer from the rich to the poor, because once again, India's inequality is an unacceptable level of inequality that we are seeing in India today. This needs to be corrected. And in the name of monetization, we must not fuel the inequality by making the rich richer and the poor poorer.
You just alluded, Kaushik, to inflation being at precarious levels or dangerous levels. Now, you're sitting in New York, where over the last few days and last few weeks, all the debate has been just around this subject, whether inflation has got ahead of the Fed, whether interest rates will now start running very high and will be raised very quickly, quicker than earlier envisaged. And that will lead to unraveling of asset prices, which have been fueled by easy money over the last few years. Where does the world stand with regard to inflation in your eyes? Because it's not just a problem in the Western world, it's increasingly looking like a problem in India as well.
Right. And you're right again that inflation is also not India specific. It's a bit of a global problem happening everywhere. In the US, it's quite high. Here is one difference which we have to keep in mind. If it becomes a global problem, each country will have to handle it its own way. One thing about the United States, where inflation is the big debate now. In the US also, as you know, there is a big segment of the population which is quite poor. And for them, the rise in price hurts a lot. The only good thing about the nature of the US inflation is it happened because money was being pumped into the hands of the people during the COVID at its peak. So there was a variety of support that the Biden administration gave directly to people. I mean, I know a whole lot of people out there running little shops and all who are getting money being given by the government. So the inflation is high. But it has been caused by money in the hands of the segment that needed it most. So there is a cushion for the poorest segment. That's not the nature in which the Indian inflation is coming. So you have to be careful that if the inflation picks up, what is going to happen to the bottom segment, which is going to be decimated. That's a worry in the United States, but it comes from there. One more thing I'll point out, because I was in government when inflation was higher than what it's now in India. So inflation had gone up to about 10%, very, very high inflation. But again, the same thing needs to be remembered. At that point of time, India's real GDP growth, per capita GDP growth, was about 8%. Real GDP growth. So people were becoming better off each year by about 7%, 8% per annum average person. Inflation is at 10%, but your real income is increasing, buying power is eroding, but the it's not taking away from the real income increase, which is real. Now it is coming on a slightly negative growth. So your real income is shrinking and you're getting this inflation of 5% or whatever it is right now. So it is hurting much more than when your real consumption grows by 7, 8%, which is what was happening there. So there are differences across countries. We have to take these very differently and plan for this. And my feeling once again is in India, we've got an extremely able Reserve Bank of India. So a lot of the inflation management has to be passed on to the Reserve Bank of India and give them the space to do that. But the fiscal policy has to be focused on the poorest segment and nothing else at this point of time.
Wonderful hearing your thoughts, Kaushik, as always. Thank you very much for your time today and for spending so much time explaining what the Finance Minister's priorities should be. But great talking to you.
Have PLI schemes proven to be a relief for sectors? How should the government be planning fiscal policies going ahead? We decode some of this with Arvind Panagriya in an exclusive conversation.
With me today, a very special guest, noted economist Dr. Arvind Panagriya, former Vice Chairman of the Niti Aayog, who is now the Jagdish Bhagwati Professor of Indian Political Economy at Columbia University. Welcome to the show and Business Today, Dr. Panagriya. It is good to have you with us today.
Thank you, Siddharth. Glad to be with you after quite a while.
Same here. Let me begin, Dr. Panagriya, with one of the standard questions that everyone would like your views on. What is the state of the Indian economy? And before you answer this, I just want to sort of bring out one paradox that a lot of us have been noticing, and I'm sure you have also commented upon it, which is that on one hand, we have bumper sales of luxury houses. Luxury cars have had a splendid December. All the German brands are flying off our shelves. Yet on the other hand, we see a significant 15, 20, 25% dip in two-wheeler sales. Registrations of that product have been falling, and it's considered a barometer for a certain economic strata. What is really therefore the status of the Indian economy at this point of time?
Right, you're starting with a googly for me, Siddharth. I would have to look into, what is going on in the credit market, because particularly the middle class and the lower middle class, they often buy these durable products on credit, and if credit is not available or not available at good terms, those sales can dip. And we know this, that when we went into crisis, there was financial markets were in a bit of turmoil, and particularly the NBFCs had been impacted in a major way, and a lot of the consumer credit comes from NBFCs. So that's where I would look. Perhaps there is an answer there, but I don't have the data. I think getting these data in real time is a challenge, and I really don't have those.
Dr. Panagriya, one of the reasons that a lot of economists who are tracking this very closely in India is that they say that prices have gone up, product prices have gone up, plus auto fuels, petrol, for example, has continued to rise. And while the government has done a recent price cut, this is one of the reasons a certain section of the economy is not seeing incomes rise, and cost pressures even beyond the headline inflation numbers are biting into their monthly budgets.
It's probable, that's not inconceivable. Inflation rate has been closer to 5 to 6%, as measured by the CPI. I'm personally not perturbed by that. I think, in a growing economy, in a developing country, 5 to 6% inflation is a healthy rate of inflation. It could also be that, we are being incredibly impatient. I'm not against impatience. I think impatience is a good thing because it then pushes us to seek solutions. We have gone through a deep crisis. And even when we went into COVID, the economy was not doing so well. The growth rate had dipped even in 1920 to 4%. So some of that residual remains. But, I'm personally kind of more heartened by the fact that investment seems to have shown a recovery. The government expenditure is holding up quite well. Private consumption, on which you are now focusing, it still remains a bit weak. But I would just, in another 6 months or so, we will see the changes happening. So I would focus on what might be ahead of us rather than what is behind us.
Okay, since you make a good point about focusing ahead, I want to therefore pick up 2 or 3 of the points that you made. You first said and spoke about 5 to 6% inflation being healthy in a way. What would that imply in terms of the monetary stance that the Reserve Bank of India should continue to implement during 2022? The reason I ask you is that there is a section of opinion which says it's time to tighten, the RBI must pull back all the accommodation that it has been doing over the last 2 years to counter the COVID pandemic. Where do you stand on that?
I think we need to stay course at this point. I would not begin tightening. We have just talked about, the access to credit, and if at this point the central bank begins tightening, it certainly is going to raise interest rates and then impact negatively access to credit. So I think that there is something which we ought to be concerned about. Particularly as far as people are concerned at large, the food prices have not done too badly. And that's the inflation that is of concern. If the food prices had been skyrocketing, I would be worried, and some action would be in order, even though it's not the RBI action which really impacts food prices as much. But that's what would concern me. But I think right now we are not in a terribly bad shape. We do need to be mindful that the NPAs, etc., get addressed. I think that's something that the RBI needs to worry about. But at this point, I'm quite okay with where we are currently.
Dr. Panagaria, were you surprised by the trajectory of inflation, not just in India, but more particularly in the United States, for example, as economies got out of the pandemic? Is it unusual? Have you yourself felt that this was something that could have been managed better? And for the Indian viewer, if you could help us decipher the current US inflation and what it could also mean for inflows going forward.
Right. So there has been a bit of an element of, the Fed Reserve, which is the central bank in the United States, and the Treasury, which is the finance ministry in the United States, fighting yesterday's war. They were, I think, very much impacted by the 2008 financial crisis. And therefore, they really, I think, in my judgment, overreacted. The transfers that got made during COVID from the very early on were extremely large, and then the Fed Reserve was extremely loose in its monetary policy, and so tons and tons of money got put into the hands of the people, and initially, of course, that couldn't produce big results initially because the shock was not just on the demand side. I mean, if there is a shock to demand, you can, through these transfers and looser monetary policy can solve the problem. But shock was also on the supply side. If people to work, if goods are not coming in, the supplies are not there, and demand alone is not going to solve that problem. That is where I think, so eventually, first, of course, those transfers translated into very large savings, almost $2 trillion extra savings in 2020 itself, actually, and then more in 2021. And so now, as the economy opened up and supplies began to come in, demand really kind of then got piled on. And so that's what translated 2020 in this very unprecedented inflation of 7%, which is highest in the last 4 decades. So maybe the 7% is something not something I would not have anticipated, but certainly that the higher inflation was on the way was quite predictable, and this is why in the Indian case, in parallel, I was very appreciative of the fact that our finance ministry did not go overboard, in spite of almost near uniform pressure actually from all quarters for India to also follow the US policy. And I think the finance minister stuck to its guns. I think I was probably one of the lone people who was at that time saying that, look, right now problem is on the supply side if people can't go to work. I mean, in fact, look, if people can't even go to buy their products to the shops and so forth, and shops are not opening up, how will even the transfer will translate even in effective demand? It won't even translate into demand.
Right.
And then the demand has to translate into supply. So there were too many obstacles. And so I think we did the right thing by focusing on providing food and shelter to everybody.
Dr. Panagaria, I'm interrupting you here because while you say that a lot has been done on social spending for the poor, and there can be no argument against it, including the vaccination program, there is significant criticism that excise duties on fuel have been used as a revenue instrument far beyond perhaps that was necessary. One cut has been done. In the context of domestic inflation, do you think it's time for another fuel excise cut to provide some relief to the middle class?
Yeah, look, these are band-aid kind of solutions. You can do that, but what you have to worry also about, and at least I have to worry about, is what do we do to the fiscal deficit that then follows? At the end of the day, somebody will pay for that deficit. The future generations will pay for it if you borrow, or somewhere else you'll have to tax. I mean, I think, this issue to me is a much broader issue, not just the fuel issue. It is the issue of fixing the entire tax system. Because, even today, what our tax revenues, except for the year 2021, which is the latest year for which I have the figures, don't have for 21-22. If I take 2021 out, the revenues have been stuck. Your tax revenue stuck at about 17% of the GDP for many years.
Dr. Panagaria, why has the tax system not been fixed? Since you seem to allude to that, are you saying that the tax system has not been fixed and the GST still needs some improvement? Is that what you're alluding to?
Well, certainly GST needs improvement, but I think there is a broader set of it. I mean, don't get me wrong. I think GST was a fantastic thing. It was a difficult thing to do, and there were a lot of growing pains with it. But a lot of the problems with respect to portal and verification, etc., have been fixed, not 100%, but quite a bit. But I think there is an issue of the entire structure of GST, not just in terms of the rates, but also the coverage. You see, I mean, in the end, we try to exclude the masses from taxation. And so income tax, you got maybe 4 crore people paying income tax. 50% of the products that are on the CPI, meaning Consumer Price Index list, They are out of the GST, they're the exempted products. Now, when you do these very large exemptions, how are you going to raise revenue? I mean, you can tax all you want the few who are part of the tax net, and you can tax all you want the luxury products on GST side. But at the end of the day, with that very narrow tax base, there is never, you can never raise the amount of tax revenue that you need. So you have to, we know that agriculture is never going to be taxed, agricultural income is never going to be taxed. That leaves out a very large part of the population. How do you bring that population into the tax net? Well, one way is to simply, widen the commodity base of GST. I think, that has to be done. And states have to be brought on board. And, I think, Govind Rao recently, our public finance specialist, he had a good proposal, in a recent op-ed saying that, look, the states are asking for further compensation, extended to another 5 years, but a bargain could be done in terms of increasing the coverage, fixing the structure of the GST. Because in the end, it seems to me that we'll never be able to expand the income tax base in the way it'll have to be if we are to widen that base. So you have to do it through indirect taxation, and that's quite a reasonable way to do it. That's how European Union does that. Large part of the tax revenue is taken through equivalent of GST, value-added tax is what they call it. So that's the way we need to go.
Well, one certainly hopes that policymakers listen to that point, because when I was studying a bit of economics, we used to be taught that direct taxes are progressive and the correct way to tax indirect taxes are regressive, but we now have a situation where perhaps some more thought needs to be given to that. Let me quickly ask you about a couple of other points, because we are very close to the budget. One more budget by the Modi government, practically the 9th full budget in its tenure. What do you think should happen as far as fiscal policy is concerned? Should the next financial year also be an expansionary one as far as the budget is concerned? Should Nirmala Sitharaman continue to keep the purse strings a little loose than before?
The debt to GDP ratio where we stand today is higher. And so it is a bit of a concern, because what we are doing, again, as I said earlier, is to pass the burden, pass the buck to the next generation. Not fair. They shouldn't have to bear that burden. So I would be very cautious. I'm personally on the fiscal side. You saw me on monetary side. I'm a little more liberal. More of a dove rather than a hawk. But on the fiscal side, I tend to be more conservative, more hawkish. I would say that we need to be cautious there. The only circumstances under which I would say, all right, somewhat looser fiscal is if we use that extra room to expand capital expenditures, build up infrastructure yet further. I think that is productive, and so if we are committed to using those proceeds, we do that. The other thing we, of course, need to do is to simply, go faster. Good progress. I think very pleased. Finally, privatizations are happening.
Right.
The DIPAM has got onto the job. Finally, we have a DIPAM secretary who is on the go. So I'm certainly very pleased by that. But maybe we need to kind of push that a little faster. Likewise, asset monetization, etc., and try to kind of handle the fiscal that way. It's a double dividend. Privatization helps productivity, and at the same time, it helps the revenues. So perhaps try to do it that way. LIC, they're trying to do so. If that succeeds, that will be a big shot in the arm. So that might be the way to proceed.
Dr. Panagaria, my next question has to do with the direction of government spending and the focus on welfare that was also necessary during COVID times. Former Chief Economic Advisor Kaushik Basu has, in a recent interview with us, offered a very critical assessment, and he told my colleague Udyan Mukherjee recently that the government's economic mismanagement has meant that not enough is being done for the poor. Given that, how would you respond to the question that I posed to you?
Yeah, look, these are all platitudes. I'm sorry to say. Kaushik is a good friend and I admire him, but when it comes to the policy, I'm not sure, ultimately Kaushik has to tell us what is he willing to cut, which is politically feasible. Anybody can say that not enough. Yes, all of us actually, who in India would be against doubling, tripling the expenditures or transfers to the poor. None of us would be, that 6,000 could be raised to 18,000. But again, where is the money going to come from? Who is the Kaushik willing to tax? Which expenditure is he willing to reduce? Which is politically feasible? Remember that he was also against farm laws. So is he willing to part with MSP? Can the government part with MSP? Can the government part with
Dr.
fertilizer subsidy?
Yeah, please continue with the point. Let me just allow me to interject. He's also said that the economic policy being followed by the Modi government has worked well for the top end of society, but it has misfired for the bottom strata of society.
Is the voter telling you that? The voter continues to vote for Mr. Modi. And in fact, it's backed by the social programs. If you look at what has been done on the social expenditures, it's way ahead of previous governments actually, in terms of, well, first of all, money that is meant for the poor goes to the poor. It's not leaking. We know from the previous governments, the famous line from Prime Minister Rajiv Gandhi, that only 20 paise goes out of 1 rupee spent. Those have been, but more than that, look, urban subsidy on LPG was ended and it was transferred to the rural poor. Just imagine the life of Swachh Bharat, that is going to impact the health of the people. Then Nal Se Jal, and spending at such a rapid pace, bringing water to everybody, every household. These are things making for the poor, all the Jan Dhan accounts, the transfers that started 6,000 rupees for farm families. These are all for the poor.
No, you make valid points, and before I move on to another topic, just one more point that Kaushik Basu made, and he says that from 2016 onwards, India's growth every year has been lower than the previous year, and he says that this is a pretty grim situation for workers, farmers, even for the middle class, and India's population, which is growing at 1.2% annually, means that real GDP per capita has shrunk, in his words, to a negative 0.1% over the past 2 years, sir.
All right. So you want to start a debate? Well, okay, I'll give you the answer. So last 2 years, what kind of economy did the UPA hand over to Prime Minister Modi? The last 2 years of UPA, below 6% growth. What was the growth rate in the first 5 years of Prime Minister Modi? 7.4%. Actually, check, 7.4%. Yes, I think 6th year, it fell to about 6.1, 6.2, something like that. And 1920 was a really bad year, 4%. So no issues with that. But at the same time, what did the previous government do in terms of lending? Recklessly, completely no oversight and no assessment of the loans, and then continuously restructuring those loans, not recognizing them as NPAs. So, a lot of sins got made, and just because in the first term UPA got to free ride all the reforms that were done by Prime Minister Rao and Prime Minister Vajpayee, you can say that, oh, we produced the growth, but what did they do? I mean, I remember asking, in an interview in Monte Carlo in 2013, I think this was on your India Today Conclave. It was 13 or 14, I think, that is there. And I said, name 3 major reforms that UPA did in its first term, which you think led to the growth that we observed during those years. And I never got the answer that at the time. So look, I think this is a bad, unproductive debate, which I try to avoid.
Sure, sure. No, I just wanted your view on these points, but as we wind down the conversation, let's come back to what needs to be done. You would definitely concede that due to some of the uncertainty that Omicron has once again injected into the economy, and we are seeing localized shutdowns, but the government seems to be very keen, state governments as well as the centers seem to be very keen on ensuring that the economy does not get disrupted. What would you, in conclusion, in this conversation say should be the priorities for the next financial year that the finance minister, that the government, and indeed Prime Minister Narendra Modi should be focusing on?
So very quickly on the list, at least 2 big things I have mentioned, I've written about. One is on trade. I think, if you're looking for mistakes, that's where I think the mistake has been made, which is a return to protectionism. We need to move away from that, both through lowering our own tariffs, tariffs that are 40% and some of which go over 100%, simply don't help anybody, not even the industry. So we need to roll back. And we need to also do free trade agreements. I think that ought to be on the finance minister's budget agenda. Higher education, that reform has not even begun. And that has to really come on the agenda back. It was there in the budget that was presented by the finance minister immediately after the elections. So that is 2 things. Now, there are other areas which need fixing, but there are political hot potatoes. The Right to Education Act clearly needs to be addressed. The Land Acquisition Act needs to be addressed. But these are very difficult reforms, and we already talked about. Tax reform needs to be done. There's even on direct taxation. At least we need more horizontal equity. Equal income should be taxed equally. But we, through these exemptions and all kinds of discriminatory rules, if income is spent in this way, then it is not taxed. If it is spent this way, then it is taxed. If it is earned this way, it is not taxed. If it is earned that way, then it is taxed. So this, at least horizontally, equal income should be taxed equally. So that also needs to be done. So these are the 5 areas, at least which require attention. Some are politically very difficult ones, but some are clearly doable. On trade side, on higher education, these are doable reforms. Likewise, tax reforms, mostly doable.
Dr. Panagaria, one quick comment. You're in the US, and the poster boy of the electric mobility industry, Elon Musk, tweeted that he was not being allowed to import Tesla cars and sell them in India, and that the government was not agreeing to a request for 0% duty. And when I spoke with government officers, they rejected this view. They said, we are not going to let that happen. We will not allow pressure through tweets guide policy. And he is welcome to come and take benefits from the production linked incentive scheme for various sectors, including automobiles. Is this an instance of protectionism? Because I tweeted about it, and there's a big debate going on that by offering some concessions to Tesla, you could have at least gotten this thing started off in India and build capacity and knowledge. Where do you stand on this subject?
Look, auto is the classic case of punishing tariffs to the consumer. Who imposes duties of 125% on imports? This auto sector, I do not understand. Why is it such a favored child? 75 years of complete protection complete protection, almost every country.
But how would we have built domestic capacities? How would the factories around Chennai, how would all that is happening in Gurugram have happened? Maruti, Suzuki, Pune, the auto hub, how would that have happened unless we gave some amount of protection to domestic industry, sir?
What about pharmaceuticals? You didn't protect them. They built up. What about the petroleum refining? They weren't protected. They built up. And they are competing in the global marketplace. You provide this kind of complete protection, prohibitive tariffs. Anybody can produce domestically. Why are you punishing the consumer?
But
why are you punishing the consumer? I think it's a punishment to the consumer, to which I object. I mean, what sin has the consumer of automobiles, the consumer of two-wheelers committed that they should be subject to such high tariffs?
So you would say that Elon Musk should get what he is seeking?
Well, I said not Elon Musk. I am saying that, look, across the board, you need to bring these ultra-high tariff rates down. Everybody, there has to be some sort of justice in terms of protecting the interests of the consumer and the interests of the producers. You cannot just say that, and these are producers of specific commodities. It's not as though, if you want to give some protection to everybody, then do through the exchange rate. Let the rupee depreciate from 75 to 80 rupees or 85 rupees. That gives you uniform protection. But these tariffs are choosing favored children who are inefficient. We have done this in mobile. You tell me one domestic producer who is competing in a big way on the global marketplace in mobiles. So there have been 7 years of protection or 6 years of protection there. Do we have one major kind of mobile manufacturer, domestic one? Now, of course, if Foxconn comes in, they always operate in the global marketplace and they will operate in the marketplace. Samsung comes in, they will operate in the global marketplace. But you name single domestic manufacturer who is actually competing in the global marketplace. So ultimately, if you say that it's infant industry, it has to grow. But auto industry, 75 years of infancy.
Well, Dr. Panagaria, those are points that perhaps deserve a much longer debate, but I'm afraid I'm completely out of time on this show. As always, it's been wonderful talking to you. Thank you very much for your time, and hopefully we'll come back and talk to you once again after the budget for next year is presented. Once again, thank you very much for your time, and you, the viewer, if you've been, thank you very much for watching.
Turning a corner now to what the street expects from the upcoming union budget. I had a conversation with market experts Andrew Holland, Nilesh Shah and Mahesh Patil, who highlighted some of the key themes that they expect to see play out in this year's union budget. What the street's expecting from the upcoming Union Budget 2022, which will be presented by the Finance Minister Nirmala Sitharaman in Parliament on the 1st of February. To discuss this, we have with us Andrew Holland, CEO of Endus Capital, Nilesh Shah, MD and CEO Envision Capital, and Mahesh Patil, CIO Aditya Birla Sun Life AMC. Great to have all of you together, such powerful voices to give us a real insight into what the street is expecting this time around. And I must say, with markets having been very upbeat at the start of the year, the question did come to mind. Is this a pre-budget rally? Even though I know for the most part, experts these days tend to dismiss any kind of lead-in, according to budget expectations. But just given the kind of momentum we continue to see, what can we expect this time around? Mahesh, let me start off with you.
Sure. No, so I think on the budget perspective, I think it's very difficult to say. But I think one thing is clear that we are coming out last year from the pandemic, and while the markets have rallied and corporate earnings growth has been fairly strong, but the underlying economy is still really not to its full potential, right? It's still struggling. I think consumption it has been weak. We've seen rural consumption getting impacted. And I think it's important, and this budget also is like 2 years away from the final elections, right? Election which are there. And so I think the government will do everything in its power to see that growth comes back, right, to its potential growth rate of around 6.5%, 7%, which what we should be looking at 2 years down the line. And to enable that, I think we clearly on the to spur demand, okay, which is still kind of weak. I think you'll see measures being taken towards that, especially the rural side of the economy, which has got impacted after the second wave of COVID. Right. I think you will see some support to that. And also to improve general consumer sentiments have also been a bit weak and tracking lower. So all in all, I think normally the budget we've seen a lot of impetus to investments, okay, for future capital investments, the infrastructure side. While that will continue, I think, which was there in the previous budget also, I think those efforts towards that will continue. But at the same time, I think the government is also trying to really the fiscal deficit, okay, after the pandemic, we've seen this year we'll have a fiscal deficit of around 6.8%. We're expecting that probably they would be comfortable around 6% for next year, because I think the government will slightly go slow on the whole fiscal consolidation path and ensure that the growth stimulus is there for the economy to really come back to its potential growth rate. So some boost to consumption. On infrastructure, there will still be challenges because the government ability to fund that is going to be limited. Right. So I think we could see some infrastructure bonds, okay, being. I think budget will probably pave a way for that. Right. There's a holding company which has been formed by the government, right, to look into the investments. So instead of on balance sheet, okay, you could see some off balance sheet kind of funding being done, okay, to spur the investments into the infrastructure side.
Okay. Andrew, let me bring you in on that point. As Mahesh also touched upon, while room for spending may be limited, they are expected to perhaps talk more about boosting capex across segments like infrastructure, which also will help to, whether it's infra, construction, roads, railway, also help to create employment and really get the economy going. Is that really what you're looking at in terms of where we may see a fillip, post the budget? Are you looking more at consumption while room on taxes, or maybe limited, but there could be perhaps other measures that the government takes to spur consumption?
So, I mean, actually expectations are probably high. I mean, the last budget was very good. So, if she can just carry on from where she left off, that would be good news too. But I think it's right. I mean, urban consumption has been increasing, but rural consumption hasn't. So obviously that's where I can see the government kind of focusing their attention, particularly as you've got some elections straight after the budget, local elections coming as well. So I can imagine that there'll be certain amount of stops towards generating consumption across the rural economy. So that's good news. I think the problem the government might face in terms of capex spending, which hasn't been as great as we would have hoped. It's obviously with bond yields and interest rates rising around the world, and obviously we would expect rates to rise here. That just increases the interest cost for the government. So it will put a little bit of a dampener. But maybe if they can just kickstart the economy a little bit more, get the animal instincts going up, if private companies to get their capex going, then that would have a multiplier effect across many different industries, particularly those supplying materials and so forth. And I think the other areas which they've been working on and done a very good job is obviously on manufacturing. Maybe there can be some more incentives there for manufacturing in different industries, and digitization. I mean, this whole digital kind of growth that India will see, maybe there'll be more focus towards that to continue for that to grow. So those are kind of basic things. I mean, obviously, listen, I've been saying for years now, we always want reduction in taxes, whether it's stock market taxes or personal taxes. If it came, it would be great for the market, but expectations are very low for that.
That seems to be the general consensus on taxes. Nilesh, what about you? Of course, the laundry list is very long in terms of sectors, particularly bruised sectors like services, travel, hospitality, that may, of course, want some kind of SOPs or acknowledgement from the government. But very often, some of that isn't always addressed in this one document. What's your biggest expectation from the budget this time round?
Well, honestly, I would probably kind of look at this budget as basically being a continuation of where the finance minister had left off during the last budget, and I think during the last budget was way more growth oriented, and clearly I think the economy has done relatively well over the course of last 1 year. Clearly on the tax collection front, especially the GST side, there has been a huge amount of positive surprise. So to that extent, I think there will be a very high level of cushion to kind of plow that capital or the collections back into the economy. So I clearly believe that this budget would essentially be a reflection of what the finance minister, the prime minister said yesterday, that this is probably the best time to invest into India. And therefore, how do we further improve the investment climate in India? And I think the budget is probably the best platform to kind of continue to build on to that aspiration which the Prime Minister shared yesterday. And I clearly believe that's the way forward. In addition to the investment side, the Capex side, I think two powerful things which will be running through this budget, or which could potentially run through this budget, is basically increased digitization, which means that how does India increasingly digitize itself at a much faster pace? I clearly believe that's essentially one of the sources of growth. And that's the way of how we could make our growth a lot more inclusive. And second is decarbonization. That to me is going to be the second biggest factor, the second biggest theme, which is going to be there in the budget. So I think it's going to be a combination of investment, growth, digitization, and decarbonization. These four to me are going to be the pillars of the budget.
That's really interesting, and given, of course, some of the recent announcements being made in order to, further their ambition of achieving certain goals on that front, we could definitely hear more outlined in the budget this time around. In terms of growth, and I know you all sort of touched upon it and shared some targets, or the fact that we all want to see, what they do to continue to boost growth. What do you feel is a reasonable expectation or target, given that where we are at currently in terms of valuations may be a little steep, but there still does seem to be a lot of room for earnings to catch up. How do you see that trajectory playing out, given the combination of what we might see on rates and inflation vis-a-vis what we might see to propel growth? Mahesh?
Last calendar was a year where we saw markets slightly run ahead of the fundamentals on the back of huge amount of liquidity, low interest rates, also a rebound in terms of the global growth. This calendar year, what we're seeing is that while growth continues to improve a bit, at least in India, but overall the liquidity environment is going to probably tighten a bit. Okay, that's what it looks like. We've seen Fed announce the tapering, and interest rates are going to rise, right? The policy rates are going to rise. The US is talking about 3 to 4 rate increases this calendar year. In India, probably we'll see 2 to 3 rate increases. And so in that kind of an environment, and also while growth is improving, global growth will be a tad lower than what it was in the last calendar year. So in this kind of an environment, you would see that some normalization of multiples will happen. The PE multiples had gone ahead of the market, the economic fundamentals. But I think the earnings growth will still be fairly strong because we are still coming out from a bottom of the economic cycle. And we expect that the earnings trajectory, even in FY23, I mean, FY22 expectation is around 30-35% earnings growth for the Nifty. And that can still be around 17-18% growth in FY23, driven by some of the domestic cyclical sectors like banking and financials, the auto sector, the industrials. So while the earnings growth will still be in the mid-teens or the high teens, going forward next fiscal year, but because of some moderation in the PE multiples on the back of the tightening policy conditions, you could see the market returns could probably be more moderate, right? Slightly lower than the earnings growth is what we should expect in this calendar year. And also you would probably see more volatility than what we saw last year. Last year, it was one of a kind of a secular bull market, right? Without any much correction, except probably in the latter half of the calendar year. I think this year you could probably see more volatility in the market, and that's what I think investors should brace in for.
In light of that, Andrew, would you look at perhaps, realigning an ideal portfolio, given the kind of gains we've already seen, given what the government may choose to prioritize now going ahead? What would you say, would be some of the changes, if any, that need to be done strategically for an investor?
So I think, Abid, I think the key is this: is that whilst our earnings forecasts are more, between that 10 to 15%. Why are we a little bit more kind of lower than maybe the consensus? Is that with this supply chain problem still there and inflation rising, I think a lot of corporates are going to have to take a margin squeeze, and they can't just keep passing it on. That's not just in India; that's globally. And the worry is that with the Fed, being aggressive, possibly on interest rates, it could spin the global economy, towards recession. Actually, before they kind of do a reverse turn, which can't be good for exports for India, which has been doing very, very well. So I think that just the first half might be a bit of a squeeze on earnings, until we get some kind of clarity of whether we are going to see a big slowdown globally. Already you're seeing it in China, and forecasts are being brought down there. So what I would say is that domestically there's going to be the reopening of the economy, and I think if I look at hotels, airlines, the operational gearing there is just absolutely huge. And I'm sure, I don't know about you, I know you travel a lot, but maybe you might travel a little bit more in India, because you're not sure of what might happen next, and if you're going to get caught in the country or coming back or quarantine. So I think people will still, for at least the first half of the year, see how things play out globally in terms of travel, and maybe do more travel internally. So I think the kind of economy-facing kind of sectors are going to do well. And within that, with other sectors, say the autos, we're all getting excited on electric vehicles, whether it's two-wheeler, four-wheeler. What I don't know who might be the winner out of all of those. I mean, I can take a guess. But what I do know is that all the auto part suppliers are going to have to supply them first of all, and then the winner will be worked out. So I think there's going to be themes within the market this year, which will really where you can make the money. So I think it's a barbell approach. I think you have some of your defensive, like IT and pharma in there, and you have some of the growth stories and themes playing out in the first or second half of the year.
Nilesh, what about financials? Apart from perhaps capital for PSBs, other tax clarifications that may come in for IFSCs, or of course for securities, anything else that you're expecting in terms of the financial pocket of the market?
Nothing in particular which the budget can basically address, but basically I think the whole idea is that the key focus of the budget and of the previous budgets and going forward is going to be an increasing formalization of the economy and financialization of savings. I think these two are essentially going to be the most powerful kind of themes that the budget would be trying to kind of work upon. And I think within that, whatever reforms that have cumulatively happened, starting from basically the Aadhaar and the Jan Dhan accounts to as recently as the account aggregator framework, clearly, I think there has clearly been a chain or a string of reforms out there. And it's quite possible that the budget could continue to unveil similar kind of, in a way, introductions or breakthroughs, which could further the cause of both formalization and financialization of the economy. Clearly, if it is in terms of basically any of the administrative stuff, I'm not too sure whether that budget is going to be the right platform for that. There could be some bit of capitalization of PSU banks and things of that kind, which have essentially been very standard features. But I think beyond that, I don't think there's going to be anything hugely different from what essentially has been happening over the last 7 years.
Yeah, you touched upon it, and of course, any tax changes for IFSCs or relaxation from digital tax, some kind of framework for cryptocurrencies, of course, is going to be a big one. I'm not sure if it will come through in the budget itself or later, but and I can see Nilesh already smiling on that one. Anything change in your view when it comes to cryptos? Is that something you're viewing, if not as an investor, but with mild curiosity and interest?
Well, no interest in cryptos per se, but I clearly believe that there's been a fair bit of debate for a reasonably longer period of time. So I think maybe it's probably now, there couldn't have been a more opportune time than now to basically deal with crypto and bring a lot more clarity in terms of whether, we are open to cryptos and how would that be taxed, how would that be traded and things of that kind. So that is something which needs to be closely examined. I mean, I think more importantly, rather than looking at cryptos as an asset class, I probably think of it as one more way of a global linkage. That if the world has accepted cryptos, how does India become a part of that? Because finally, we all live within, globalization. And so to that extent, India will need to take a call on this at some point of time. I probably think that there couldn't be a better time than now to basically take a final view on cryptos.
Andrew, what about healthcare? While we may see an overall expenditure increase by the government on that area, there are certain pockets of the market that stand to benefit. For instance, if we see further SOPs announced for segments like hospitals.
No, I think the government will continue to focus and spend money on the health sector. I mean, if COVID hasn't taught us something, then it would be pretty poor of us to kind of leave the sector untouched. So I would suspect that we'll continue to see more monies kind of expended towards the health sector. I mean, but we're all going to spend more money anyway going forward. So if we have the infrastructure and it's feasible for the hospitals to expand, then I think that will be great news for us all, right? I just want to touch on the crypto though, because I think it's an important point. In that I do feel that the government will probably make the right moves here. And whether it's a tax as an asset or not, I'm not really that worried. It's more about the missing out part, because we know globally what's happening with NFTs, what's going to happen with the meta, and to miss out of that whole development process, of which Indian people, I think, can be at the forefront of all of this, would be a big revenue earner for the government to kind of walk away from. So I think if you look at the bigger picture and just go away and say Bitcoin and buying and selling coins, we're all going to be doing something different in terms of how we buy things in the future, not just through Amazon or anything else. It could well be through the metaverse and other places, which are developing very quickly.
This is so interesting, and I think it's one of the few times that I'm hearing how perhaps crypto can evolve into an actual tangible asset that people consider, and not just a volatile investment bet. But Mahesh, let's talk about divestment, because that's a big one. And while there may have been some delays, we've got LIC, BPCL very much in the news. What's on your radar when it comes to divestment?
So divestments has been kind of elusive. I think this year also probably will not meet the target. Again, it can be blamed on the pandemic, and a lot of players would not be able to do their due diligence. But I think the government is fairly committed on that, looks like, and they haven't really used alternatives to really monetize, like doing the ETF, like PSU ETFs, which they had done earlier. So clearly they are looking at more strategic divestments, because that's where they can get the real value of the underlying assets. And I think a lot of work has happened over there in a lot of these large names which they have announced. And already the list of companies, where they want to divest, I mean, that list is ready. So I think the preparatory work has been done. It's just a question of timing because of the current environment. But I think most of these things will get deferred into the next fiscal year, looks like. And I think you should see more of these divestments coming to the light. Also, I think government has last budget, they indicated about kind of a national asset monetization program, okay, where they identified around 6 lakh crores of assets. I think you could see some more clarity on that, how they're going to monetize that. And so I think it will be in work in progress. There is LIC, as you know, is a large ticket divestment, and that alone can take care of bulk of the heavy lifting of the whole divestment program. But one has to wait and see, okay, how soon they're able to really come in and tap the equity market. There should be decent appetite for that. It's the largest insurance company, and there should be a lot of retail interest in that, as well as institutional interest. So while this year looks challenging, I think next year, looking at the preparatory work which has been done and the assets which have been identified, I think it should be a fairly good for divestment, presuming that the markets still remain buoyant as what they are.
Okay. So just as we wind up then, and I think we've covered a lot of ground, and I've got a sense of what, you know, each of you are sort of expecting from the budget or looking at 2022 with in terms of a strategy or a point of view as to which themes will dominate. You know, since we are having a conversation with some of the best market minds, have to ask you in terms of sectors that you feel will dominate in 2022 with or without a slowdown, even with easing liquidity. You know, is it going to be deep cyclicals, export oriented, urban consumer, manufacturing? What would be your pick? Andrew, let me get your favorites first.
So I said it's more of a barbell approach, Dava. I mean, you know, the telecom sector, digitization, 5G, 6G, you know, all to do with the metaverse and everything, I think is going to play out, you know, very strongly over the next 1 to 2 years. Within the banking sector, I'm probably, you know, less bullish. I think there's a lot of disruption going on, not only in the private banks, but with, you know, obviously newcomers coming in as well. So I think it's going to be a struggle, to be honest, for the financial sector. So I'd rather kind of go more towards the insurance and asset management companies. That's probably where I think that the things will play out better. And in terms of, you know, the kind of local economy, obviously I've mentioned hotels and airlines, I think will do well. And within the autos, you know, look for those auto part suppliers to the EV industry. They're cheap, and you know, they've got a lot of catching up to do. So those are the kind of broad themes I would play at this point. I mean, again, defensive, you know, more pharma, but I'd probably have IT and telecom there more than pharma at this stage.
All right, got it. That's a nice comprehensive list. Nilesh, what about you?
Clearly continue to kind of have a bottom-up approach, look for companies which you believe are going to do extremely well across these 4 pockets, which is basically deleveraging-led Capex. Clearly, that's going to be one big, powerful area where I see continued sustained growth momentum. The second essentially is demand-led businesses, be it across urban or rural demand. The third is digitization. I clearly believe that a lot of especially consumer-led businesses are powered by technology and digitization and could sustain basically pretty strong growth going forward. And the last is around decarbonization, which broadly is around renewables, electric vehicles, and those kind of opportunities. So clearly like these 4 pockets, and I of course, these are pockets which have done well in 2021. And I believe that this will continue to be the course for 2022 and even beyond 2022.
Mahesh, closing comments from you.
Yeah, so just I think continuing, I think broader theme, I think if you look at for going forward would be domestic cyclical. I think India's recovery has still been lagging behind, but I think you should see that there are enough legs for economic recovery to really improve, even as global growth slows down a bit. So domestic cyclicals, so be it banking and financials, okay, where you will see credit growth pick up, credit costs will come down, valuations are reasonable, so that looks to be a good sector to do well. Real estate is another sector which has kind of come out, okay, after almost 6-7 years of a down cycle, and the conditions are really good in terms of interest rates. The affordability gap has come down. There's a lot of organized players coming into that space, so that sector could also have a good cycle for the next 2-3 years. And all the sectors linked to that should do well. And finally, I think while it's still early days in terms of revival of the private sector capex, but the way the government focused on manufacturing, the whole PLI schemes, the China Plus One policy, I think we are seeing some green shoots on the capex front. Companies are talking about it. So if I take a 2 to 3 year view, I think industrials, could be the sector to watch out for, which again has been in the last 5-6 years, hasn't seen much of a growth. Whole investments to GDP has collapsed. I think we will see a revival of that going forward. So all in all, I would say that we are more positive on domestic recovery if we take a 2 to 3 year view. And I think that's where the growth could surprise in the coming years.
Fantastic. On that optimistic note, and with so much to choose from, I think it's looking good for investors who are, looking for opportunities in the market, regardless, of course, of what may or may not be announced. But we look forward to hearing what the Finance Minister has in store this 1st of February. Gentlemen, thank you so much for joining us and really discussing in detail some of the expectations this time around from the Finance Minister. Thank you so much. Now let's take a closer look at what the recommendations are of the top industry body, CII. CII President TV Narendran sat down for a detailed conversation with BTTV's Managing Editor, Siddharth Zarabi.
With me today is a very special guest, TV Narendran, the Managing Director and Chief Executive Officer of Tata Steel. He's also the President of the Confederation of Indian Industry. Welcome to the show, TV. Let me begin by asking you about the most pressing concern that seems to be weighing on the economy, on policy makers, on industry and the Aam Aadmi, which is the rapid spread of the Omicron variant. How do you think this is going to impact the economy? And before you answer that question, let me also share a data point. In response to a Business Today survey asking people's opinion on the feasibility and need of lockdowns to prevent the spread of the virus, an overwhelming majority of the responses said that there should be no lockdown because it will lead to significant economic pain. Where do you yourself stand on this matter?
Thanks, Siddharth, for having me on the show. Yes, the concern that you shared is a real concern. The spread of Omicron has been rapid, but I think it's been milder than wave 2. So to that extent, people are not worrying as much as they did when wave 2 was spreading. There is certainly a concern on livelihoods. So if people feel that the risk to lives are less, they want to make sure that the livelihoods are not impacted. Because after 2 waves of COVID, a lot of livelihoods have been impacted, which is reflecting in a bit of fragility in the consumption. So I think it's not surprising that people don't want the lockdowns that they've seen, particularly in wave 1 and sometimes in wave 2. I also think industry is better prepared today to deal with it. Government is also more experienced, both at the central and the state level. And there's better coordination, or there can be better coordination between the central, state and the governments and the industry to make sure that the economic impact of COVID wave 3 is not as significant. As we saw in wave 2 also, the economic impact was not as significant as wave 1. So if this is a concern, we also as citizens have to exercise restraint and avoid unnecessary risks to ourselves and to our families, and help the government to take care of COVID with the minimum lockdowns that are required.
We saw in the first wave and then the second wave the disproportionate impact on smaller businesses, the service sector. We are now seeing fresh restrictions which vary from state to state on small businesses, the health business, for example, in terms of the gyms and other restrictions, creeping curbs, weekend curfews. Is there a way to deal with this? Should the respective state governments who put in these curbs also at the same time announce some support measures for those sections of industry? Large companies like the one that you represent have the wherewithal. But for smaller businesses which barely survive and are on the low margin side, why shouldn't the state governments and the center provide them some support, immediate support?
Absolutely. I think your point is valid. If you look at the recovery post-COVID, many sectors have done well. Some sectors have struggled because they've been the most impacted by wave 1, wave 2, and now wave 3. Right. So our submission to the government has also been that the MSME sector needs to get the support that it's been getting. We need to continue with that support. High contact service sectors like the ones that you described, whether it's fitness, whether it is restaurants, hotels, tourism, aviation is just about coming back, etc. So some of these sectors need support, more than other sectors, and in fact, support can be directed to these sectors because some of the sectors don't need any support. So we agree with that. Whether what is it that can be done at the center and the state needs to be discussed with the local governments. But certainly as part of our budget proposals also, we've been saying that these are sectors which specifically need some support from the government.
One of the other features of the government response to the corona pandemic and the economic recession slowdown that occurred as a result was that while it opened up the fiscal tap, where it spent quite a bit more than was originally envisaged, some people say that direct income support for the underprivileged, for the weaker sections, and for the small and perhaps micro enterprises across the country is still lacking. Do you think the forthcoming budget should keep this in mind and appropriately respond to the evolving situation?
So we had, Siddharth, we had a few suggestions to the government. One is, of course, to continue with the support through Manrega, because that has been substantial and that has been important. So one is to continue with that as much as is required to make sure that the recovery is complete, particularly in the rural sector. The second part is to say, how is it that we can spend more on creating health infrastructure? Because if you really look at household incomes at the middle class and the lower middle class and the poorer people, they've been hit by the fact that their health expenditure has been far more than they'd budgeted 2 years back or 3 years back. So there is a concern that household budgets are under stress, household balance sheets are under stress because incomes have been hit. If the family is working in some of the sectors that have been more impacted by COVID, jobs have been hit and expenses have gone up in some of these areas. So there is a concern. Those are the households that need support. At the lower levels, you have Manrega. At a more higher level, it's more about how can you secure them against such kind of unplanned for expenses in the future by great expenditure in health infrastructure, and also to create something like a pandemic pool, a pool of capital that is available to respond to any future pandemic, and that can be created over a period of time. And CIS also submitted a paper to the government on that. So I think these are all areas to be done, and the more we can do about creating jobs and stability of incomes, the better chances that we will have of consumption coming back with the momentum that it had in the past.
Why do you think the government has not been able to, for example, provide greater tax write-offs for the higher medical expenditure? I'm talking of what is allowed on the personal income tax front, where there is a small amount of money that used to be deductible. Now, you yourself have mentioned that there is significant amount of medical expenditure that a lot of families have suffered. There are other issues that have come up. Do you think it's also time for the government of India, which provided a big corporate tax relief a few years back, to also do something on the personal income tax front for salaried individuals, for small business owners, for example?
Siddharth, one needs to look at it in the overall context, because if you look at it from the government's perspective, they've spent far more on vaccination than they had planned to, right, by providing it across the country. So, and now with the booster shots, etc., there are a lot of expenses the government is directly incurring, which would have otherwise been incurred by the businesses, corporates, or individuals. Right? So the government needs to see how is the money best used in the most impactful way, so that it reaches all citizens.
The other side of the argument, allow me to interrupt you, the other side of the argument would be that the government has raised substantial revenues from elevated retail prices of petrol and diesel, for example, and that has been used for the vaccine point that you made. What I'm trying to understand is, for a government which a few years back provided a huge tax giveaway to corporate India, is it not time to also provide some tax relief on the direct tax front to the individual taxpayers. You have GST rates, which is a completely separate budget outside the budget now.
No, I'm not arguing against that. All I'm saying is that, one needs to look at how much of money the government needs to spend on what. And if it is first ideally spent on vaccines, then it should spend it on vaccines before it gives the tax relief, because the tax relief is also relevant only to a certain section of society, whereas vaccines are relevant to all sections of society. And I think, to be fair to the government, till 3-4 months back, they were also not clear how much will be the revenues vis-a-vis the expenditure. I think the GST collections have been great. The recovery has been strong. Tax revenues have been strong. That probably gives the finance minister more headroom to maybe pursue some of the ideas that you're suggesting. But certainly the fiscal health looks much healthier than it was maybe 6 months back.
If the fiscal health is much better than what it was a few months back, what are the other key suggestions that you have made from a boost for growth, a booster shot for the economy?
Yeah. So the first and foremost is, of course, to continue to spend on infrastructure, because that is a force multiplier in many ways. It creates a lot of economic activity across the country, because a lot of infrastructure is being built in rural areas. It creates jobs, it creates incomes for MSME sector, and it creates infrastructure which makes Indian industry more and more competitive. So I think that's an area which has multiple impacts, and we say our recommendation is please continue to spend, even as much as private sector investment is slowly coming back, but let the government continue to spend on infrastructure that it has promised to, and do it quickly and efficiently, which it's trying to do. The second part is on the consumption side, which we just discussed, is to look at how do we create more stable jobs, how do we improve the quality of jobs, how can we support labor-intensive sectors as much as capital-intensive sectors, how can we create incentives around job creation, how can we support sectors like textiles, leather, etc., which is more labor-intensive, and also electronics, which the government is anyway supporting and getting a fair amount of investment. The third part is how can we increase the spend on education, because a lot of children have been impacted by what has happened. So the investment or the expenditure on education is about 3% of GDP. How can we take it to at least 4% and higher? So because once you invest on education, skills, health, etc., hopefully you're dealing at a long-term fundamental level and creating more opportunities for people to go up the economic ladder. The other suggestion is also about improving the ease of doing business, so that we can continue to get more and more private sector coming in. And the last point is to build a long-term roadmap on climate change, on technology and knowledge-intensive sectors, and also to encourage a startup ecosystem. So these, in a summary, of what we've been talking about. Some of it will have a short-term impact, and some of it will have a more long-term and medium-term impact.
One of the other points that we have been seeing in the past few months is, as pricing power has come back to industry, it's been able to raise prices also on account of rising input costs across the board, as well as shortages and supply disruptions. Do you think the price increases across sectors has also played a role in impacting demand? The auto sector, for example, or steel, which you yourself know so much about.
So, some of this increases have been because of the recovery being faster than people expected and consequent disruptions to supply chains. Right? So the supply side was not as ready. The logistics side was not as ready. So you had a shortage of containers, you had a shortage of inputs. Second thing which is happening, which is impacting everyone, is China is tightening up. China is reducing export. China has set its own net zero goals and certainly does not want to export goods which are carbon intensive, which are being produced in China. So they are saying we produce carbon intensive goods for China, but we don't want to produce carbon intensive goods for the world. And steel is one such commodity in that list. So that's having an impact on anyone who's been dependent on China as a source. So some of these changes are temporary, or pressures are temporary. Supply chains are already settling into the new normal. I think commodity prices have settled down to a more decent level than we saw maybe 2-3 months back. Container freight rates over the next few months will slow down, will come down. But there are some areas where it is still a few months away, like semiconductor supplies, there's improvement. But if you look at the passenger car industry, it's been impacted more by supply than by demand. There's enough of a demand for passenger cars, the supply which they've struggled with. Whereas some of the others, like motorcycles, have struggled more with the demand side. So I think it's a mix of both. Material in prices are one part of it and has impacted, but I think that will settle down to more normal levels over the next few months as supply chains settle down. But there are some structural changes that we need to be ready for.
Are you confident that private sector investment will pick up? We've seen the government do most of the heavy lifting in the recent past, and there are sectors where industry is now promising to invest, and hopefully the Omicron evolving situation will not be a major hurdle. Do you think private sector investment is going to pick up in your position as the head of CII? What do other members tell you about that particular aspect?
So the general sense we got last month when we did a poll, we do a poll every time we have a national council, is that more and more CEOs are saying that the capacity utilization is improving. It's 70 to 80%, in some cases close to 100%. They're seeing demand growth both in India and in the international markets. Many are exporting well. Many have repaired their balance sheet, so they deleveraged. Profitability is improved for most companies, in many sectors. So as a consequence, the general intent was to increase investments, and that was the sense we got. I think a large number of our members said they have investment plans. If you look at sector specific, again, some of the sectors which have traditionally been the big private sector investors are metals. And I think metals, particularly steel investments, have already been announced. I think the steel industry is investing something like 15,000, 20,000 crores a year. They've already announced more than 500,000 crores of investments. Chemicals is another area where we're seeing investments come back. There are also investments happening in industrial supply chains, in warehousing, logistics, networks, etc. So there are different areas, and of course, more recently in electronics manufacturing also, and the PLI schemes are also attracting investment. So we are certainly seeing private sector investment come back. It is still only 1/3. Like you said, 2/3 is government investments. The heavy lifting is being done by the government. But private sector investment is back to what it was pre-pandemic. Now we need to get back to where we were maybe 8-10 years back.
As we wind down this conversation, a couple of other points that I want to get from you. One, as the president of CII, what's your view on crypto regulation? The reason I'm asking you this is that it's a big phenomenon. There are a lot of people who have dipped into this. There are several operators. We've seen a bit of a back and forth. Would you be on the side of a ban or a regulation? What is the stand that you would like the government and the RBI to take?
So I think as CII, the position we have taken and we've made is that we think it should be treated like securities with a different kind of oversight. So it should be seen as an investment class, like securities treated like a securities, and there should be some regulation. It's not an outright ban, but in a regulated environment, we can create room for cryptocurrencies, etc. And so that's our view, and we've submitted a paper on that, and so that's where we come from.
Has there been a delay in framing crypto regulations, TV?
I think all countries are grappling with it because it's an emerging area. There are not too many precedents to go by. Some countries are banning it, some countries are over-regulating it, some countries are under-regulating it. So I think different countries are evolving their own strategies for it. Central banks are obviously involved. So I think we should allow the Indian government also to syndicate with all the stakeholders which they're doing, taking inputs from bodies like CII, and then come to whatever is the right long-term conclusion for the country.
Let me ask you another crucial point from your recommendations to the government recently, in which you have said that the government must adhere to the fiscal deficit target of 6.8% and reduce it to 4.5% by financial year 26. In the light of the evolving situation and perhaps business activity getting impaired to some extent, do you think you would stick to this advice, or would you want the government to be a little bit more fiscally spending right now?
When we started, we thought 6.8 will be difficult to achieve, right? But I think the revenue collections have been quite robust. The recovery has been quite robust. And so the assumption is that with the kind of investments that the government is making in infrastructure and the kind of money it is keeping aside for it, the recovery can continue to be strong if the impact of wave 3 that we are experiencing now is not so significant. So I think if we continue with this pace of recovery, and the CII forecast for next year is 8.5% growth, then we should be on target for 4.5% fiscal deficit in the next few years. But if it is, for some reason, the economy doesn't recover as much as we expect it to, then of course we can look at what else needs to be done.
One of the other points that I've noticed from your recommendations is on disinvestment. The question I have for you here is that we have seen some plans for disinvestment not really fructified, despite the markets being on historic highs. There is also the additional plan for the national asset monetization. As a leading light of industry, do you think there is something more or different that the government needs to do to actually fulfill all the promises on disinvestment and national asset monetization?
So I think the intent is right. The execution is always challenging because of the political pressures and various other issues which come up to the government. So I think as CII, we welcomed Air India. There's Nilachal Ispat and a few others happening. There is LIC and a few others as well. So I think there is some momentum. Every year, there's a gap between delivery and promise on this, but I think the intent is there. There are some complexities that the government is dealing with. Directionally, they are clear that's where they want to go, but the execution is taking a bit more time than they thought. So we will be patient as long as they're moving in the right direction.
The farm sector law repeal, has industry taken that in stride really? That was something that was purely political and it does not impact the government's resolve in any way?
Well, CII was supportive of the reforms in the agriculture sector. For whatever reasons, it did not work. But I don't think we are seeing that as an indicator that on other reforms also they will be backtracking. I think overall the commitment is there. I think it's very important for the country to create conditions conducive for private sector investment, as we've just discussed. Government can't keep doing the heavy lifting. So you need to create conditions conducive to encourage private sector investment across sectors. And so from that point of view, all reforms are not only essential, but it's an imperative.
My final question, we've discussed the state of the economy. I also want to discuss the mood of industry. TV, how would you describe the mood of industry in the new year, 2022? Most of the pain hopefully behind us. What's your view on that?
Obviously, there is some concern of wave 3, which is rapidly, getting worse, but hopefully a milder version compared to wave 2. But there are some sectors who certainly need support. And I think while many in industry, including the sector that I represent, has done well, there are many who are struggling, services sector, as we discussed, and some of the MSMEs. So I think it's a bit of a mixed bag. Overall sentiment is positive, but there are pockets of industry which certainly need some support.
Absolutely, and that's what we would expect from the forthcoming budget. The budget is being presented in circumstances that have rapidly changed, and very clearly, the government of India will have to continue to do heavy lifting to provide the economy support and boost growth. TV Narendran, as always, thank you very much for your time on this pre-budget special on Business Today. With that, it's a wrap on this show. If you've been, thank you very much for watching.
One of the big questions this time, will the government rein in on the rising fiscal deficit, or is it best left unattended for now? We take a closer look at this with backstage reformer and former Planning Commission Deputy Chairman Montek Singh Ahluwalia.
We have on the show for you another very eminent economist, Dr. Montek Singh Ahluwalia, former Deputy Chairman of the Planning Commission of India. Montek, very nice to have you on the show today. And I want to begin by asking you about this K-shaped recovery, which has now become common parlance. Should the finance minister be making her peace with the fact that it will remain K-shaped, or do we need to do something to change the shape of that alphabet, given how badly the bottom end of the pyramid is hurting?
Let me first thank you for inviting me to join your show. On the specific question that you ask, you're right that there's been a lot of focus on the fact that the economy is recovering. The fact that it's recovering is certainly a good thing, though it's not unexpected, because, we were very badly hit by the pandemic. So having gone down probably more than most other countries, it's not surprising that we have seemingly recovered. As you say, the recovery is not uniform across all segments, neither sectors nor, if you like, income groups. And I subscribe to the view that what you're seeing is a recovery, but it is K-shaped. And the question we now ask is, should the finance minister worry about that? Well, clearly anything that doesn't bring the benefits of a recovery to large numbers of people, especially at the lower end of the spectrum, has to be a cause of concern. But what exactly she can do about it in the short run is another issue. Because as far as the recovery is concerned, I mean, the year is almost over. So really the question is, what should she be doing in next year or in the budget for the next year? But to some extent, what should she be doing for the remaining couple of months? My view on this has been always that given that we were hit by a recovery, in the short run, a worsening of the fiscal deficit compared to what was expected not be a problem. We had apparently projected a fiscal deficit of about 6.8% of GDP. That was based on, I think, an outcome, a projection of growth, which is probably not going to be realized. So in the remaining months of the year, I personally think that rather than being too hung up on hitting that 6.8% target, she can actually afford to do a certain amount of expenditure, which actually would help the economy. Now, in this list of things to be done, to my mind, one of the most important really is to make up the transfer that is due to the states because of the shortfall on the GST compensation. Because, there's far too much focus in our discussions on the central government fiscal deficit, whereas really from a macroeconomic point of view, the deficit that matters is the combined deficit of the center and the states. Now, the states have not been given the shortfall in the GST which they were originally promised. Many of them are therefore running very large fiscal deficits. Some of them, by the way, may not be showing the fiscal deficits because they're just delaying expenditure. And that is actually contributing to the slowdown in the economy because bills are not being paid, etc. So I think that for this year, I don't think it's that important to stick with the 6.8% that was originally targeted. If the growth rate that we are achieving is actually less than what we had originally anticipated, so you can in fact justify a somewhat bigger deficit. And probably the areas she should concentrate on, as far as the current year is concerned, is either make the transfers that are due to the states for the GST compensation. And I don't know, by the way, what has been the final position taken by the government on whether we're going to make that transfer or not. But to my mind, it was clearly promised, and therefore it's worth taking a step forward in that direction. She started the business of transparency by bringing things onto the deficit which earlier were left out. But actually, there's quite a lot which is still outside, like the GST compensation that I mentioned. So I think it's a good opportunity to say, well, look, it's been a bad year. We've recovered not as much as we had expected. And so if the fiscal deficit is a little higher than 6.8%, I don't think that matters too much for the current year. Now, it's a different issue what she's going to do for the next year. And I mean, that is very directly connected with what sort of a growth expectation she has for the next year. And, on that, people have very different perceptions. I mean, we should not be mistaken by the fact that we have probably end up with a growth rate maybe somewhere between 2.5% current year, but that doesn't mean that's going to continue next year. So really, we need to know what is the government's own expectation of what the next year's growth rate is going to be, because the budget has to be structured around that.
Fair point. But whatever that growth rate may be, Montek, I want to ask you what your prescription would be for next year in any case. Given the need for transferring the GST compensation to the states for this year, next year, if the government's assessment is that growth will not be as strong arithmetically or optically as this year, what needs to be done? Because one route is to try and stimulate consumption at the bottom end of the pyramid in some way. The other way is to throw your money at the investment basket and try and stimulate the economy that way. What would you advocate?
Well, we are already doing things to support the income levels at the bottom, and those should certainly continue. I mean, for example, the MGNREGA expenditure, which is actually demand for rural employment programs has been much stronger than was projected. So I think we should allow for that fully under the nature of the legal provisions of MGNREGA. That is, in fact, an automatic entitlement, and next year's budget should allow for that. Otherwise, quite frankly, I think the notion of treating consumption as something that would lead to a recovery is, I think, a little misleading, because, consumption will recover when incomes recover. So there is a case for doing something for the poor, and we should certainly do that. But any other stimulus of demand, in my view, should go in two areas. One is to strengthen health expenditure. That's not actually necessarily investment, because a lot of it may well mean supporting expansion in health services, certainly vaccinations in the coming year. But other than that, it should really be investment oriented. And if you're clear about this well in advance, and we are going to do more expenditure, that's where we should concentrate on. But that decision has to be based logically on the clear assumption that, look, if we don't do it, then growth will not be what it should be. We cannot simultaneously claim that we are going to grow at 7.5% and say that we also need fiscal stimulation. So I think from an analytical point of view, what we need is a clear sense of what's going to be the growth rate without the stimulus, and that if that's not good enough, then we justify stimulus. But even there, for the next year, it is from a macro point of view, and it's not fair to throw this at the finance minister, because the central budget cannot pronounce on the states. But I think we need to be clear what is the fiscal position of the states. And the problem there is that the fiscal position of the states is not very transparent. And most of them are running much larger deficits than they show. They're simply not paying the bills. So I think to get a good sense of what the macro balance should be, we have to take a combined view of the two and then say, look, this is what we're aiming at, a combined deficit of so much. And for that, maybe it's worth saying, how much are we going to allow the states to borrow? Because after all, in that sense, the central government controls the total amount of borrowing that the states can do. And that should be added to the central deficit. So we say we are targeting a combined deficit of whatever it is.
This combined deficit number cannot be too small, as you know, Montek, and that is the rub of the problem. Because if the finance minister, as she probably will, takes your advice and says, I will not get too hassled about the fiscal deficit getting a little out of control for the near term, but on the other hand, that runs the risk of inflation actually getting even more entrenched, and that's a problem which is fairly global right now, and in India too. So would you worry about inflation this year as you talk about a looser fisc? Or would you say, let me help the economy on the fiscal front and let the Reserve Bank deal with inflation?
No, I think, look, the inflation connection is not necessarily determined just by the fiscal deficit. The inflation factor is determined by how much you monetize the deficit. I mean, if you simply, the problem with deficits is that they squeeze out the private sector, okay? So if you do more government expenditure, there's less for the private sector. If it is your judgment that private investment is not going to expand, then it makes sense to say that, look, until the private sector recovers, we are going to give a boost on government expenditure. That boost will be an investment-related government expenditure, because that is what contributes the most to the growth of the economy in the longer term. This I come back to what I said. A lot of people, because they think on the demand side that consumption somehow contributes to growth, they say, well, if growth is slowed down, why don't you speed up consumption? Well, actually, consumption is an endogenous factor. I mean, an economy generates consumption when income occurs and income expands. So our focus should be on expanding income. The best way of contributing to the medium-term capacity of the economy to grow is to increase investment. And the biggest shortage in India right now is in terms of both the quantity and the quality of infrastructure. Now, that's an area where the government is deeply involved. It has had ample advance notice of what needs to be done. And if a clear decision is taken that we are going to do this much on the Capex side of the budget, I think that makes a lot of sense, and we should do that. Now, the important thing in the fiscal deficit is really, if your trajectory is seen to be one where you're not bringing the fiscal deficit under control over 3 or 4 years, then I think there's a lot of cause for worry. That's why it's the medium term that matters. And the critical thing in the medium term is what's the growth rate, because that's what determines the denominator. I mean, if you get stuck with a set of policies that don't generate growth and simply say, I've got a good fiscal deficit, I don't think that that's going to impress anybody. But if you can persuade people that, listen, I'm running a little bit of a higher fiscal deficit this year, but I'm also following policies that will actually stimulate growth, I think people will perceive that in the medium term, you're making the right transition. And that's what we should be focusing on.
Now, to come back to your point about stimulating investments and this infrastructure investment that you just spoke about, Kaushik Basu last week was telling us that India needs to get back to that 38-39% kind of investment ratio which we had back in 2003 and even in 2010-11. What is your recipe for getting back to that kind of investment rate? How much would you have the central government do? And do you think these recent initiatives like the production-linked initiatives, etc., can actually draw in the private sector and get the investment level high up again?
Well, on this one, let me say that what has fallen is private investment. And that too, not corporate private investment, but non-corporate private investment. That means small-scale investment, housing, etc., and so on. Whether we go back to 38%, we're now probably somewhere around 30%, maybe a little lower. We certainly need to get back to somewhere around 34%, if not 38%. And most of that expansion really has to be in the private sector. It's the revival of the private sector. I don't believe that by concentrating on the public sector, you're going to revive the economy. But where the public sector can actually deliver infrastructure, which the rest of the economy needs, this is a good opportunity to put in a little more in there than you would later on. So as far as what to do, that's pretty clear. Now, what else is needed? I think we should recognize that looking ahead, you mentioned the production-linked incentives. I think that what we need is a clear recognition that we have to have a much better export performance. I don't actually mind a few selective production-linked incentives in critical areas, but we have 13 sectors that we've listed for production-linked incentives. I would have said that in what you might call the green energy area, or developing green hydrogen, or developing battery technology, things that in the transition to a low carbon economy, the country needs, and there's a lot of technology to be brought in. Some selective support there might be a good idea. But otherwise, I think the real reason why we are not competitive in global trade And that is preventing exports from doing as well as they could. I mean, we must remember that we are doing worse on exports than Vietnam, we're doing worse on exports than Bangladesh. And both of them are facing the same global situation. So why is that? I personally think that the decisions that we took in the last 2 or 3 years of raising import duties were, I think the finance minister received bad advice. It may seem like a sensible thing to do to protect domestic industry, but the fact is that what the raising of import duties has done is to raise the cost structure of Indian industry. I mean, this is what the 1991 reforms made a turnaround. And several successive governments, including the government of Prime Minister Atal Bihari Vajpayee, continued the trend of reducing duties. And the principle that was followed, and I mean, Yashwant Sinha, as the finance minister, actually restated that principle, that we want to get our duties down to the same level as they are in East Asia. Now, we've reversed that. I think the government was poorly advised by whoever gave this technical advice. And I would be very happy if the finance minister were to say that, look, as far as customs duties are concerned, we have a medium-term objective of bringing the rates down to the same level as exists in Southeast Asia. And to that, with that end in mind, this is what we're going to do in the current year. I mean, she doesn't have to do it all in 1 year, but the signal should be clear. The danger at present is that the signal is that if some domestic industry promises that if only you raise the import duties, then I will do well, the chances are that the government will succumb to that promise. Now, there are many distinguished economists who advised the present government who have actually said the contrary. I mean, the first chairman of Niti Aayog is Arvind Panagria, a very distinguished trade economist in Colombia. And he has categorically said that we should reverse this raising of customs duties. And more recently, the former chief economic advisor, Arvind Subramaniam, has said the same thing. So I personally think that in any outlining of tax policy, we should junk the notion that raising customs duties is a good idea, and we should put back on the agenda, how do we get back to bringing our customs duties down? Let's be clear, we are trying to join the global economy. Many people, Prime Minister himself has said that he's in favor of global value chains. We should integrate with global value chains. We cannot integrate with global value chains if we don't bring our duties down to the same level as other countries in East Asia who are actually competing with us for joining these global value chains. And I feel that, even the decision that was very unfortunate that the Commerce Ministry decided not to sign the RCEP agreement in 2019, although, it was the present Prime Minister who had put out the signal that we must act east. And that's a good slogan. But, acting east, the logical consequence of acting east would have been to join the RCEP agreement. And it would have signaled to the rest of the world that, look, if you want to locate production facilities in India, in order to service other countries, then India's customs duties are going to move in line with what's happening elsewhere. See, at the moment, we may be able to attract people to produce things in India behind high customs tariffs. But this production is not going to be the basis for successful exports. And obviously, we are a moderately market things. It's always possible to attract people to set up production facility here, but that production facility will essentially be an assembly of imported components. And I don't think that's really the long term what we want to do. We want to develop a deeper production capability, which will link up with global value chains, and we export to fit in with other people's products in order to service the global market. That's what we need if we want to revive exports.
Let me ask you about another aspect, which is the government's asset monetization program. But last budget too, there were quite a few announcements about how 2 public sector banks will be privatized. That has not happened. Now, from your perspective and experience at the Planning Commission, why do you think it is so difficult for the government to push through some of these divestments or privatizations? Because they could actually yield very useful capital for the government to deploy in areas of investment and infrastructure.
I think we need to separate out what we call asset monetization from privatization, although it might look like the same thing. At least my understanding of asset monetization was that, in the infrastructure area, we have a lot of functioning assets that are worth. These were assets that were built in the public sector. And since they are functioning and they're operational and they're generating revenues, we would be able to sell them off. And with that sale, the resources that we get hopefully could be used to build other public sector infrastructure assets. You could argue that why do you need to build it yourself? Why not let the private sector build? The answer there is that very often, when the private sector is asked to construct assets, it runs into all kinds of problems of land acquisition. Even when the land is actually with the government, there are problems of clearing encroachments, things which are very difficult for a private sector guy to do, but much easier for the government to do. So the solution is the government builds the asset and then sells it. And the private sector maintains it and so on, either sells it or gives it on a 40-year lease or something. And the private sector essentially operates that asset and maintains it. I think there's a lot of sense in that. And I don't know why it has not succeeded as much as I would have hoped. Very often what happens is that, we announce something, but in the actual implementation of the sale, a great deal depends on the terms on which the sale is being offered. On which the asset is being offered. But I think that if we were very clear that these are the assets, and we set up a high-level team to produce a concession agreement on the basis of which the assets can be sold, we would find it easy to establish demand for the asset. Now, this requires a reasonable judgment on what kind of return you can get. If you overprice the asset, nobody will buy it. But I think that's certainly a possibility. The second thing is privatization. And in the case of the 2 banks that you talked about, the real purpose of the thing, to my mind, is an explicit recognition that as long as banks are under the administrative control of the finance ministry, they will not be able to resort to efficient banking. Now, I've been in the finance ministry, and I'm aware that ministries hate letting go of anything. But after much consideration, my view is that we should privatize a few of the public sector banks. We don't have to privatize them all. So I hope that this privatization of 2 banks actually goes through. I have no idea of where it stands or what progress has been made. I just don't know. But certainly, since it was announced, I'm not surprised, by the way, that this takes a lot of time. But it would be good to hear from the finance minister whether she now has a very clear plan of action as far as these 2 banks are concerned, with the terms on which they're being privatized being made very clear and bids invited so people know who's eligible to bid.
Montek, always a pleasure hearing your thoughts, but we're out of time today, so I'll leave it there. But thank you very much for taking time out today. Great to have you on the show.
Thank you. Thanks very much.
As we count down to Budget 22-23, will volatility around global cues and the Fed's meet continue, or will Omicron also continue to play spoilsport for the equity markets? Is the bull market far from over? Are we entering a super cycle? We assess all this and more with Morgan Stanley's Rhythm Desai.
We are asking a lot of old-timers in the market what the budget can do this time for the stock market. I'm Uday Mukherjee. With me is Abha Bakaya, and our special guest on the show today, Rhythm Desai, Managing Director of Morgan Stanley. Rhythm, good to see you on the show again. It's quite a day to have you on. Do you think it's going to turn out to be one of those years where the union budget becomes a sideshow and all the attention is hogged by volatility in global markets?
Well, yeah, potentially it can be. I mean, we've been anticipating volatility around the Fed's exit, so it's come, and that's appropriate. It doesn't mean the bull market is over. We had a similar situation in 03-04 when the Fed exited, and there was a lot of volatility. This is not 2013. I think the 04-08 cycle, as we've discussed in the past, is more relevant to this one. But of course, we'll see. The budget, yeah, I think it can still bring relevant things to the table. India has got a fair bit of idiosyncratic factors that are going for it. And amongst them is a new profit cycle. So I would still be keenly watching the budget. I mean, it is never a sideshow. Its impact on the market, though, at least short-term performance, has been waning over the past 3 decades. And even the volatility on budget day, which used to be quite intense in the 90s and the first decade of this millennium, that also has reduced a fair bit. And maybe this is because budgets have evolved. It no longer has the ingredient of indirect taxes in it. Direct taxes are far more stable. The fine print has kind of gone away. But the overall strategic thrust of the budget, I think, is still relevant. It's very relevant to how this bull market shapes up in the coming months.
We'll talk a lot about that, Rhythm, but first a little bit more about this global volatility. I mean, how intense do you expect it to be? Because, I mean, the Fed seems to be ratcheting up its intensity and its urgency quite a bit in the last few pronouncements. Do you expect, I mean, a fair amount of fall has already happened in the high growth areas in the US, the expensive stocks, the technology stocks, but do you see much more ahead in the next few months?
See, I think, Udayan, I would be actually quite encouraged that the Fed has expressed this urgency, because the risk, one of the risks, and I think we discussed this on the previous show, one of the risks to the bull market was that the Fed fell behind inflation. Markets hate a Fed or a central bank that's behind inflation. It applies to the RBI as well. And the risk was that given the pandemic, central banks were taking less chances. They were being, erring on the side of dovishness, and inflation was, building up. So the fact that the Fed is a bit more urgent, aside from this volatility, is actually good news for the growth story ahead. And if the Fed, does keeps its nose ahead of inflation, the markets will actually like it eventually. This is, par for the course. We've been in an environment of very low interest rates for several quarters now. And if interest rates are going up, then as you very rightly point out, high growth stocks, which are trading at high multiples, are the ones that take it on the chin. The market is discriminating between those and the rest, where multiples may not be as rich. So the headline indices have not corrected as much as what has happened underneath. And I think that will probably remain the narrative for some time. And then you get some sort of capitulation, which I think then causes indices to bottom out. So that could be the path ahead. We still need to see what the Fed does and how exactly it pans out and how much market prices in before the Fed event.
Okay. Back to the budget, Rhythm. I mean, there are two views that the finance minister might actually take another year before she gets back to the path of fiscal consolidation, and therefore peg the coming year's fiscal deficit to say around 6.5%. There's another view that now that tax collections are so buoyant, she will now get back very urgently to the path of fiscal consolidation, which she deserted for a couple of years because of the pandemic, and therefore the fiscal deficit projection is even closer to 6%. Which one would the market like more? Which of these two options would the market like more, and what kind of stocks would come to the fore in the event of each of these outcomes?
So I think, Udayan, I would like to call it as a credible fiscal consolidation. The path is what the market will like. So the 6% number, I think, will be welcomed by the market, so far as it's backed by credible estimates. We are in one of those rare years, and actually we have to go all the way back to 2006, where government had the luxury
of choosing between fiscal consolidation and spending because of buoyancy in tax revenues. So it's been a while since India has had buoyancy in tax revenues, and that's a very good thing for the markets as well, because it allows the government to make a choice. Let's boost growth further. Let's spend more money and delay fiscal consolidation for a year, or let's focus on getting to the path of normalization by consolidating the fisc with some credible numbers. I think that's the latter which the market will celebrate, because when you're spending in a growth recovery, then the risk is you invite inflation. Also, what that does, Udyan, is it actually restrains the RBI. Remember, the RBI also needs to exit, and we're expecting the RBI to hike the reverse repo rate in February and then follow it up with successive rate hikes. The Fed is on a hiking path, so the RBI can't stay far too behind. I mean, no doubt India's macro stability is a lot better than it used to be. But even then, the RBI can't stay too far behind the Fed. And if the government pursues a path which is a little bit more on the fiscal expansion side, then it does create a bit of a problem for the RBI. Now, on your second question, which I think is very interesting, is what trades? And I think this all actually points to the probability that financials deliver stellar outperformance. So the RBI is likely raising rates, which means the short end goes up, which means financials have higher yields on their assets. The liabilities reprice a lot later, so their margins expand. I reckon that after the recovery in economic activity, credit growth will follow. And we can all opine that credit costs may have peaked because profits are recovering now. So this is really, a situation which financials will really love. So I would expect that sector, which has not done so well. And you've been in the market very long, Udyan, and you know that bull markets in India have rarely been created without financials. In fact, it's hard to remember one. We have to go all the way back to the mid-90s when consumer staples drove it. This has been a rare bull market which has not been built on outperformance by financials. So I think 2022 looks like to be a year of financials. Now, your second situation where the government chooses to spend money and not consolidate the fisc, I think will probably play into the hands of the consumer stocks. So that means more spending by the government, which I reckon will be in rural and infrastructure. So industrials and consumer stocks, I think, could do well. So those would be, I think, how the market would react. The market will probably like the first scenario more than the second.
Rhythm, just want to get a take from you also on, the global bond indices. There's been a little bit of chatter around that and possibly an inclusion coming in on that front. Is that something the market is expecting to hear in the budget?
So I don't think the market is expecting it. It doesn't look like it's priced into the bond markets or the equity markets. It's something that we are expecting. And what exactly are we expecting? We're expecting clarification on the taxation of income that fixed income investors coming into the fully accessible route bonds, FAR in short, that's the acronym for fully accessible route bonds, have to pay. So essentially, it's an exemption from filing returns because Euroclear has promised the government that they will do the needful on behalf of these investors. And if the government does go to that extent, then I think it will set the stage for an inclusion of India into global bond indices in a couple of quarters from now. So maybe the third quarter of this year. Now that entails massive inflows. Just the passive flows that could come in the subsequent 12 months could be of the magnitude of $20 billion. It doesn't count for the active money that comes in. India, for the first time, will actually attract that type of inflow. And there will be a global yield profile that India will have. It will take the burden of financing the government's deficit partly away from domestic banks. So they will feel a release of liquidity, which they can then put into work into the credit market, which essentially means private investments get crowded in, and you also get a bid on the 10-year, so the yield curve flattens. So all these are really massive implications for India's growth and for India's BOP. So if this clarification comes, I think this may be the biggest takeaway from the budget.
We were talking earlier about how rising interest rates globally actually flatten the valuations on some of these very expensive stocks. Do you see something like that happening in India as well, Rhythm? Because there is a class of high quality, high valuation stocks which have done very well over the last 2-3 years, longer. Do you see their valuations coming off now, or do you see this global volatility actually playing into their hands as people rush to the safety of quality again?
So Udin, there are two types of high valuation stocks. And when we say high valuation, we mean high P. I need to qualify this because, that's the way people interpret it. So let's call it high P, not high valuation. So there are two types of high P stocks. There are those which have steady cash flow and very strong cash flow generating capacity with very high return on capital. Think about the traditional consumer staple stocks or some of the consumer discretionary stocks. Companies which have very strong moats and therefore have very good cash generating capacity, have been rewarding shareholders for years, and are businesses that are unlikely to be disrupted in the coming decade or so. Those multiples I don't think will get threatened by this because their businesses are not dependent on low interest rates. Their businesses depend largely on growth continuing. And if anything, they've been actually grabbing share from smaller businesses and have been consolidating market share. And if growth accelerates, then they will see further uptick in their cash flow. Then there is this second variety of high PE stocks where actually those companies don't have current cash flows. Their cash flows are a bit far out in the future. They're all investing today for those future cash flows and for future return on capital. Those type of companies and the stocks of those companies may actually hurt a bit. So those that are investing for cash flows that are a bit too far in the future are the ones where I think there is a bit of a threat. So two categories, and I think that's already happening actually in the market. So it's not like the market is about to do this. Those PE multiples have come down a fair bit in the past 2 weeks or 3 weeks since the Fed made its intentions clear. Not only in India, but in fact, it started with the US and now also spreading to India and other markets around the world.
Now, a quick question on disinvestments, because this year the government is going to fall way short of its projections. What do you see the calendar of 2022 for divestments playing out like, and what ramifications could it have on the secondary market?
So I hope that the emphasis is more on privatization. That's why the national monetization plan sounded very exciting to me, rather than just selling piecemeal stakes in government companies. And I think that shift is already underway, and hopefully that accelerates over the course of the next 12 to 24 months. The privatization brings a completely different dynamic to the table. Firstly, it's not supply into the secondary markets because it's taken off the secondary market. Second is that it creates the possibility of higher return on capital and better cash flows for these businesses, which then benefits minority shareholders that are invested in them. So hopefully the emphasis is on privatization rather than divestment. And in the event that it is privatization, if there are some delays, I think that is understandable because the process of privatization takes a whole lot longer than coming to the secondary market and offering a few shares for sale.
As always, Rhythm, there are so many expectations that this budget will somehow deliver a magic pill. And we all know that, they are constrained somewhat this time around. Given the kind of sell-off that we're seeing just in the build-up to the budget, I mean, we started the year on a fantastic note. We understand that, if we look forward towards the rest of the year, we're still in a super cycle. But given the kind of sell-off we're seeing right now, from a market standpoint, do you really feel that anything that's announced in the budget could possibly fire up sentiment to that extent again?
Yeah, but the history stacked up against people who want to trade this on the short run. So if you look at the past 30 budgets, and that is as far back as I go because we start from 91, 92 onwards. The 2 out of 3 times the market has gone down in the 30 days after the budget, irrespective of what the budget has done, irrespective of what the market has done prior to the budget. Now, if the market goes up before the budget, so it's trading up in the days prior to the budget, then the probability of it falling rises to 80%. So essentially, you're dealing with a situation where the market invariably tends to sell off post-budget. Now, this is purely short run. Budgets, I think, should be viewed beyond their impact on stock markets on a 15 or 30-day basis, or even a 3 or 4-day basis. And I think we should lay more emphasis on the strategic shifts that happen in terms of government financing, in terms of government spending, and in terms of taxation. So those are the things I tend to focus on. The market, I think, is up against a grim history. So if it goes up, then of course it can, because 1 out of 3 times it does go up. That's welcome. That'll be good news.
Rhythm, I also wanted to check on the LTCG. Market is rife with buzz that it might be hiked to 15%, and that's spooking investors.
Yeah, it was in the air last year as well, and it's in the air now. The introduction of long-term capital gains tax in 2018 was not such a, it was a successful experiment. The government has collected taxes. And, there is this opinion that long-term capital gains tax should be aligned with the other taxes in the country. My own view is that it's still early days. India still needs a growing pool of risk capital. We can't be continuously relying on global investors to provide that for us. That's what's happened over the past 30 years. We need to encourage further flows into equities. It's a very nascent story. If investors and one of the things that equities does is provide this lower taxation benefit, especially for those who are willing to hold it for the long run. So I would hope that this incentive stays. If the incentive goes away partly, yes, you're right, it will spook the market. It did in 2018, and it could again, especially the broad market, small and mid caps, could really get hurt in the short run.
What are your colleagues in the international desk saying, Rhythm, right now about how emerging markets might play out in 2022? Because now you were starting the year with this intense volatility about interest rates going up, maybe faster than what one thought before. What ramifications could it have towards flows? Because 2021 wasn't exactly a bumper year in terms of FII flows. What is this year looking like?
So see, Udayan, I think EM as a cohort has now stopped trading in unison. So this is very different from, say, the previous bull market, where EM traded as an asset class. So it traded kind of in a single direction. Within that, you had a few outperformers and underperformers. The dispersion within the EM basket has widened considerably over the past few years. And that's because, various EMs have done varying degrees of structural changes. India is actually on the right-hand side, which is it has done better than most other EMs in terms of policy reform, and therefore stands to actually behave differently from the weaker EMs. But EM as a cohort, I think, ceases to really play out in the fashion it did in the past. Now, on your question on flows, I think that is going to still remain a struggle until the dust settles on the Fed and things have kind of flattened out. Right now, from a global standpoint, our strategists think Europe and Japan stand to gain from the current situation rather than EM and US. So we see more volatility in EM and US than Europe and Japan, and it's kind of playing out in that fashion. Beyond what the Fed does, I think India will, make a comeback. And for India, actually, the capital flow or, the bid in the stock market is coming from various sources. So it's not just foreign investors, as we have seen in 2021. For years, I have fielded calls from investors about what foreign investors will do. And for many, many years, I've said, why is that question so important? And 2021 has proved that it's not the most important thing for us to worry about, except from a macro perspective, which is that it does help our BOP. But that too has now diversified. We have got potential fixed income flows. We have huge amount of FDI. We have private equity flows. So many other sources of inflows have developed over the past few years compared to, say, 20 years ago, when the only source of inflow for us used to be FDI flows. So even the macro implication of this has actually waned.
So let me ask you about the other part of inflows, which has actually been more important for us this year, which is the local money which has come in. Do you see any panic coming in there? Because this looks like it could be the first meaningful correction since the pandemic began. And a lot of the new money which has come in has probably not experienced a 20% kind of a correction. Do you think people locally will hold their nerve if we see a correction of that magnitude?
No, then they will get tested. And it's a good thing to get tested because it will underpin their commitment to equities. We did see flows actually weaken during the pandemic period. So it was not, it was only after several months that equity investors returned after the break they took post March 2020. But the secular story in equity flows actually dates back now 4-5 years. And it's reminiscent to what happened in the US in the early 80s. Two things that happened then. Paul Volcker moved the interest rate framework to run positive real rates. And the Reagan administration allowed 401k plans to invest in equities. Very similarly in India, actually, in 2015, the same changes happened, which is the government mandated the RBI to target inflation and therefore effectively run positive real rates. And it also allowed provident funds and national pension scheme to invest in equities. So we had very similar changes, and I expect a similar path for household ownership of equities as we saw in the US in the subsequent 20 years from 1980, which was continuous inflows, which withstood a whole lot of market volatility, including the famous 1987 October Dow crash. So yes, there could be temporary slowdown in flows, there could be even outflows, but the systematic investing that India has now started, I don't think will go away. So that number did not fade even during the pandemic. I think it's unlikely to get tested by a 20% correction. The non-systematic flows that we saw, say, for example, in the month of December, they were very large. They could easily get taken out and they could turn into outflows, and that could always happen. But I think equity investing in India has arrived, and we're in for a secular run on this. Households still own only 5% or so of their balance sheet in equities. If that number has to double to 10%, which is still a pretty low number over the, say, next 10 years, I mean, you could get 50, 60, 70 billion dollars of inflow every year for the next 10 years in a growing fashion. So the household saving pool in India is not small. It's about 20% of GDP. So they're saving about $600 billion. It's not a tall ask for 50, 60 of that to go into equities, which now, by the way, Udyan, on a 1 year, 3 year, 5 year, 10 year, 15 year, 25 and 30 year basis is the best performing asset class in India, beating gold, beating treasuries, beating property, beating every other thing that households own in much larger quantities than equities.
No question about that. No debate either on which asset class does well on the long term. But good of you to point it out, Rhythm. Thank you very much for your time today. Pleasure talking to you, as always.
Thank you.
And finally, what are some of the macroeconomic priorities from this year's budget? We find out from our esteemed economists Kaushik Das, Madan Sabnavis and R. Gopalan.
With me today, a very special panel of guests to discuss India's economy, the prospects of growth, and the dark clouds of Omicron that pose a threat to the ongoing recovery. Joining me today, Kaushik Das, Chief Economist, India at Deutsche Bank, Madan Sabnavis, the Chief Economist at the Bank of Baroda, and Mr. R. Gopalan, the former Secretary of Economic Affairs in the Union Ministry of Finance. Welcome to the show. Let me begin by asking you, Kaushik, about the key priorities that you see in the emerging situation as far as Finance Minister Nirmala Sitharaman is concerned. She's already had several rounds of meeting, and the key budget numbers are being shaped up even as we are speaking. What are your key expectations from the forthcoming budget?
Hi, Siddharth. Thanks for inviting me to your show. This third wave that we are talking about, it doesn't come as a complete surprise. In fact, for the last few months, we've been always kind of fearing that there will be a third wave at some point of time. We just didn't know that it will come through the form of an Omicron related variant. But, the cases have started increasing. And I think these cases will keep on increasing and probably will peak at some time during February. So this particular third wave obviously will have some effect on the budget formulation. And as far as expectations are concerned, this fiscal year, we have set a fiscal deficit target of 6.8% of GDP, which could go up to 7% because the government has announced more spending in the last month. From there, we would expect that next year they would set a fiscal deficit target of something around 6.5%. Because you would need to support the economy for a little bit longer period of time. We have had a lot of fiscal support in the last 2 years, but given the third wave, we would still need more support. There are two other aspects related to the budget formulation, the challenge, the delicate balance that the finance ministry will face. One is supporting different stakeholders of the economy to ensure that demand kind of is supported, but in a way that it doesn't stoke inflation. Inflation is also becoming a big concern worldwide, and India also, we've seen inflation remaining above 5% on an average for the last several months. So how do you form a budget which supports the economy but doesn't cause inflation? And in that way, the government has been supporting capital expenditure. So I would expect capital expenditure to remain strong, and that should create a multiplier impact. And the third aspect is, how do you finance that fiscal deficit? How much do you borrow from the market? Does it cause interest rates to increase? Then whether RBI can have to come and buy again bonds. So those issues will come up. So it's a very delicate balance. So I would say we are going with 6.5% of GDP worth fiscal deficit with some bit of support, targeted support for different stakeholders who need the support at this point of time.
Kaushik, what you're saying is continued targeted support and a reduction, even if by 30 basis points on the fiscal deficit. Madan, let me come to you on that before I go to the former policy maker on the panel. Madan, you heard Kaushik, and I would want to begin my question by asking you, given what has happened to the recovery and given what now seems to be happening with the third wave, and we'll all pray and hope that it passes by very, very quickly without causing any major damage, do you think it's time for the government of India to target a reduction in the fiscal deficit, or should it continue at least from the current year's point of view?
No, I think, Siddharth, as far as the government ideologically is concerned, I would tend to believe that they would be looking at lowering the fiscal deficit ratio, something in the region of 5.5% to 6%. Now, I think the critical factor will really mean that will depend upon what happens in the next 15 days, whether there are lockdowns and curfews which are imposed for a longer period of time. Because we should remember that a critical part of our economy, the services sector, was something which was getting back on its feet. And I remember during October, November, we were quite euphoric, thinking that the pent-up demand has come into services and it's only looking upwards from now onwards. So it all depends upon what the center, the states, the municipals, the panchayats do in terms of lockdowns, because that could actually push back growth. And if that happens, the entire concept of the budget is going to change, because you will need to continue to spend money on relief, because I don't think the states have the wherewithal to spend on relief. So that particular component will have to continue. But knowing the government, the way in which it has behaved in the past, I think moving along the fiscal path will be a priority. And I think side by side, there will of course be this entire saga of disinvestment, because I think that's something which has not yet played out. We're not quite sure if it's going to happen by March. So I think fiscal deficit, capital expenditure, disinvestment, these are the three main things which would be on the agenda of the FM under normal circumstances, which will continue to be even this year. And in case of lockdowns being imposed beyond, say, January 7th, which I think looks very much likely to different measures, then I think the government will have to peg away at certain relief expenditure. Of course, there will be this conundrum about how revenue is going to increase, because we know if there's a lockdown, automatically there will be a hit which is taken by both the center and the states, and there's GST compensation, so on and so forth. But that is something which they will definitely keep up. So I think the compromise may probably be on the fiscal deficit ratio, but definitely I think 5.5% to 6% is what we will be looking at. Maybe 0.25 more, maybe a compromise in case there are further lockdowns in various parts of the country.
Madan, one very quick point before I go to Mr. Gopalan. Do you think it's time to be ideological? Ideological in the sense that India was perhaps the only major economy where the central government, the government was conservative during the pandemic last year, and the Reserve Bank let loose the monetary tap. do you think it is time to be ideological or be more pragmatic?
No, but I would say, practically speaking, I look at the government as being ideological. So therefore, I think they're going to move on this path, because when conditions were tough, they chose to follow a kind of a fiscal path which wasn't giving too much of freebies, help the poor, let the rich, enable the rich to get back on their feet. And I think that's the policy which they will pursue. There's no reason for them to change things now. I don't think they will do it, even though we can say that it should ideally do it. But I think practically speaking, I don't think the government is going to say, look, let me stick to 6.8 or let me go to 7.5% fiscal deficit and get us out of the rut. I don't think that is the path which the government will choose.
Mr. Gopalan, you've been part of several budgets. You've been right in the thick of it. I want to ask you, do you recall any other time during your long career, including especially in the Ministry of Finance, where in a matter of 3 weeks, practically, the scenario seems to have changed, the estimates seem to be changing, and more importantly, expectations and the animal spirits that drive any economy, they have been impacted in a very short period of time due to the third wave. And what Madan said in terms of the ideology and the very concept of the budget changing, do you think that is what is actually playing out inside North Block right now?
Well, I mean, I would say that, this is the third wave is something which is something which we have never seen. This kind of an interruption in the budget preparation process. So we start the process 2 months before. So the numbers we start, getting into, and we finalize expenditure at least a month before. So then it's about the last month when we look into various other issues which crop up. But this kind of a Omicron kind of a third wave did not hit us at any point in time during my budget preparation. So this is something very, very new. As far as philosophy is concerned, yes, we had grappled with some problems at some point in time about when the 2009 crisis, when we were trying to whether to continue with the benefits which we are giving for reflating the economy, should we continue with that or not? That was something which kept on for quite some time until the last about 25 days. But barring that, I don't think we ever had this kind of a issue. And philosophy change, it's just not possible, because once you start laying down the philosophy for the budget, which is about 2 months before, it's not possible to change the philosophy unless you have some very, very critical and important happenings which have taken place and which requires resources to be diverted elsewhere or resources to be put into some other place. Then that's a different issue. That has never happened in my time.
Mr. Gopalan, one quick point. What kind of budget would be ideal in the current economic situation? We still need to support growth. We need to do much more for job creation. And there is obviously inflation that's also been inching up gradually.
Look, all these are very important aspects to be looked into during this budget. But inflation is slightly a different thing, except on the supply side, where we try to do something to ensure that the supplies, are not prevented from happening by any other method, any other means. That is something we'll be very cautious about. So supply side enhancement is something which budget should do based on the programs and promotions they do through various departments and various institutional structures they prepare or they create at that point in time. So these are all things which can happen through the budgetary process. Otherwise, inflation is something which is a different phenomenon, altogether. But the budget also has a philosophy on what do we do? Do we look at the inequality? Do we look at the consumption improvement at this point in time? Do we see that the export infrastructure which is required to be beefed up to take advantage of during at this point in time when exports can really go up? These are all things which are looked into, and I think by this time all those things will be under the belt, and they would have had extensive discussions and then created a few openings for that.
Well, clearly it's not an easy exercise for the Mandarins in North Block. Kaushik, coming back to you, it's very clear that one of the key possibilities at this stage, and once again I'm saying this with the hope that it doesn't pan out like that, but if we head towards more restrictions on economic activity, inflation is possibly going to respond in a way which will be positive, but not given the circumstances. What do you expect from a macroeconomic point of view, given the situation now? And I know it could change 2 weeks later, but I'm still asking you to give us a forecast.
No, Siddharth, you hit the nail on the head. And I started by saying the budget has to be such a way that it supports growth, but it doesn't stoke inflation too much, because at the end of the day, if you have inflation, it hits the poor the most. So you're giving with one hand and taking from the other if inflation goes up by deflating the real income. So you need to be careful of how you decide to spend the money. So the government has been, stressing more on capital expenditure. In this year, the capital expenditure is up 30%, the budgeted number, 5.5 trillion. So I would expect the government to put more emphasis on capital expenditure even in FY23, because that also has a big multiplier impact as far as job creation is concerned. And the center will also push the states to spend as much as possible on capex, because we know that the state capex has more multiplier impact on creating jobs. So I would assume that the targeted support, the demand-driven support, will only be given to the needy and people who need relief, not for the entire, economic class. So they'll pick and choose where they need the most, and then the major thrust will be on capital expenditure, both from the center and state. And if you look at the budget numbers for FY21, the first wave, then what we had, our total fiscal deficit was actually close to 14%. We keep on talking about just the center, but you have to add the states, and the states were close to 5% of GDP. So my inflation forecast is 5 to 5.5% for FY23. And this year also, FY22, it's supposed to be 5.3%. So we are having a scenario where inflation is unlikely to come below 5%. And you know that RBI's target is 4%. So we are looking at a scenario of inflation being 100 basis points or 150 basis points higher than RBI's target. And if you have a supply shock because of the supply disruption like we saw in the second wave during May, it could happen that inflation could be on the upper side of the range, close to 5.5%, and sometimes going to 6%, rather than staying within the 5.5%. So it will take some time to bring inflation back to the 4% target, and that's why the budget has to be striking a delicate balance to ensure that inflation doesn't move beyond that threshold 6% mark.
Madan, we are yet to see crude respond in a meaningful way. In the recent past, there was, of course, something that happened early on in December. Given that, and given the current domestic supply scenario, the food and vegetable scenario, some of the sticky points when it comes to domestic inflation, food inflation, which is politically sensitive, we have 5 state elections. What kind of priorities do you expect on that front from Nirmala Sitharaman?
So actually, I believe that the budget can do little to influence inflation. Okay, we're having elections coming up. We know it's a politically sensitive issue, and definitely it affects everyone. But if you look at it practically speaking, if you look at the way what is causing inflation today, if you look at all the food products, which is maybe 45 to 50% of your basket, I don't think the government has any control over what happens to the prices of cauliflower or onions in the market. If you look at non-food products, if you look at anything concerning oil, we've seen that the Brent price has again started moving upwards. That's a concern. And I think even though we have seen the central government reducing the excise duty by 10 rupees, I continue to pay 110 rupees for petrol even before and after in a city like Mumbai. So I don't think prices have come down. And given the fact that there is this uncertainty again about what could be, restrictions coming on account of this third wave, it's quite possible that again the government revenues will get affected, and it will be convenient for them to continue to make sure that the petrol, diesel become good sources of revenue for the government, both center and the states. And if you look at the other products which we're looking at, I think there's been a lot of correction which has taken place in terms of global commodity prices, raw material prices going up, so prices have gone up. Services become more expensive, and most of these services and commodities, they run on the MRP concept. So when the MRP goes up, it really comes down, even in case there's a correction in prices. So therefore, I think the budget cannot really address issues of inflation. Just I also believe, I wouldn't like to get this into a discussion that even the RBI cannot control inflation. You can react to inflation, but RBI policy cannot bring down prices of onions or tomatoes, but that's exactly the situation which holds also for inflation. So I think the finance minister is going to just stick to this particular agenda. And I think contrary to what Kaushik is saying, I think that I look at a budget more in terms of an account. It's a kind of a balance sheet and profit and loss account of the government. We should not be expecting miracles to come from it. A lot of that expenditure is committed. You pay interest, you pay subsidies, you pay salaries. I think expecting a lot of it from the budget probably may not be, it may be a bit too carrying things too far. I think the capex number is of course important, and that 5.5 lakh crores can become 6 lakh crores, 6.5, but definitely not more than that. So even though we are talking of a number of around 35 lakh crores as the size of the budget, ultimately at the end of the day, the government, what is going to influence growth, what we're talking of, is going to be this 5.5 lakh crores of capex. And as far as inflation, as I said before, I don't think either the finance minister or the RBI governor can actually bring it.
Right. Mr. Gopalan, one of the key points that I heard recently from the policy making establishment is that the Modi government does not believe in instant budgets. And this was in response to a question that I had posed my interlocutor about what are the kind of priorities that will be dictated by big elections like Uttar Pradesh. Now you handled all of those. That's why I'm asking you this question. Since by all accounts there are no instant welfareist budgets that have been presented by the Modi government, directionally do you see political reasons also weighing in a please all kind of a budget which also provides some further boost to the campaign in battleground states like Uttar Pradesh?
Well, I don't think so. This is not a general election. This is a state-specific kind of elections. 1, 2. Most importantly, what do people look at in the state? They want good governance, prices down, and a law and order, and all your other government, seva, whatever they do, they're all, done seamlessly without much of a problem. And general corruption in administration is done. These are some of the issues which these people really want in the state government. So much of it is state-specific. But on the prices side, obviously, the state government can always say the center was responsible. But as Madan has indicated clearly, what is that the central government can do on the inflation except increasing the supply so that the prices really go down is something which we need to look at. So that they can do if they can reduce the taxes on import taxes on materials like edible oils and the pulses and those are some of the things they can do in the budget. But at the same time, we have been not looking clearly at what kind of institutions we should have to ensure that they are able to deliver these things to the public at least cost, prices. That is something which we have not, looked into so much in the hullabaloo of budget making. But that is an area which I think government should look into and see that, they are able to address this problem. But most importantly, a budget cannot, influence, state elections, as I mentioned. But budget is a foundation which is laid for a long-term growth prospects of the economy, and therefore, on investments on infrastructure or investments on any other, human infrastructure creation, correcting some of those which are already there by various means which can be fiscally done, and laying out certain policies which will enable through the budget and spend some money on that so that people are able to appreciate, and then the delivery at least takes place in a meaningful way. These are some of the things which budget should attempt, and I'm sure this budget will certainly attempt some of those things. That's my hope.
Right. Kaushik, from a revenue point of view, and all of you have reminded our viewers that ultimately the budget is basically a balance sheet exercise. From a revenue point of view, how do you expect the government to end this year? I ask you on the basis of what has been happening on the direct tax collection front, including even the number of returns that has been filed, and we have seen GST collections also go up. Minus the third wave, what's your sense as far as revenue is concerned, and will that provide the government some basis to spend more in the next financial year?
So Siddharth, our calculation suggests that this year, revenue collection this year, as in FY22, the year that will end, revenue collection would be about 25% net of what government has already spent on additional. For example, the GST compensation cess has been given without borrowing from the market. So you would expect the increased revenue kind of funding that GST compensation cess. Then the excise duty cut that was done, that was also, 50,000 crore that, was kind of the revenue loss that the government suffered because of that excise duty cut. So 50,000 crore plus 1.6 trillion GST compensation cess that has come from the increased revenue. Even if you take that out, then revenue should still be 20-25% up on a year-on-year basis for FY22, which is a very good number. Fiscal deficit could have been lower, but you know that last month the government decided to increase the spending by INR 3 trillion. So that's why I'm saying the fiscal deficit for this year will remain constant at 6.8 or it can slightly go up to 7%. Next year, our assumption is that nominal GDP growth would be about 13%. So about 7.5% real GDP growth. And if you add 5% or 5.5% inflation, 13% nominal GDP growth. So you can get to 15-16% revenue growth on the back of that nominal GDP growth of 13% even next year, despite having a 20-25% increase in this fiscal year. The things that we need to look out for, one is disinvestments, as Madan mentioned. So if LIC IPO doesn't happen this year, obviously next year, LIC and BPCL will give huge, revenues to the government. Or probably we could have LIC finishing this year and then next year we'll have another pipeline of disinvestments. And, the GST collection, you're seeing that every month we are tracking 1.3 trillion. So maybe 1 or 2 months we could be on the lower side. But from next year, we could see again, GST collection probably moving higher. So there would be revenue support. Only thing is, how do you spend in such a way that the support goes to the people, those who really need, and you have a multiplier impact through the capital expenditure. And capital expenditure from the government side can actually, prompt the private sector to also come and join in the Capex because, they haven't invested for a long time. So we are hoping that in FY23, you'll see private sector Capex also coming in along with the government push for expenditure. Just one last point I want to make, Mr. Gopalan said about execution. The government has announced a number of schemes in the last 2 years, including asset monetization scheme, the PLI schemes. I would not expect the government to keep on announcing new schemes. The best action would be to implement whatever has been announced, and there is a huge pipeline. And even if you execute 70-80% of that each year, I think you will have enough revenues to fund the expenditure needs to support growth at about 7.5% in real GDP terms.
Madan, one of the points that's also true about the current year, a year when markets were at historic highs, is that we haven't seen much versus expectations on disinvestment. And of course, the Great Indian IPO, as we are calling the proposed LIC IPO, if it happens in this financial year, will add. Otherwise, it is probably going to spill over to next year. There's also the national asset monetization pipeline, for which we saw an announcement, and we are still awaiting concrete next steps in that regard. Do you think that side of the government's ambitions as far as disinvestment and the broader sense of government getting out of areas where it shouldn't be has not really worked despite the markets being at historic highs?
No, I think this has been a problem all through for disinvestment, because I think whenever we're talking of disinvestment, and I think this time the number has been really high at around 1 lakh crores, what we're expecting from LIC. It's all a case of timing and getting the right price. I think that's always been a controversial issue for the government, and that's one of the reasons why things move very, very slowly. And I think the decision-making process needs to be sped up. I think that's the only way in which you can do it. And ideally, I would tend to think that the right way to go about it is that in the beginning of the year itself, one has to announce saying that on a certain date, I'm going to disinvest a certain company. So otherwise, there's always a case of saying, am I getting the right valuation? The market value will be different. We have seen the Sensex reach 60,000, fell again. It seems to be going up. We really don't know in March what the Sensex will be. Let's assume that the Sensex comes down to 50,000 for some reason. I mean, at that point of time, I don't think that disinvestment will go through, because the kind of valuation which we have for LIC, which is a very good number, I think that's not something which the market may be prepared for. So I think disinvestment is always going to be a tricky issue. In terms of asset monetization, I think we should remember one thing, that whatever monetization takes place goes to the company and may not come into the budget. I think that may be a technical thing.
Yes.
Mr. Gopalan can actually throw light on it. So it's actually not going to help the budget, because if NTPC is able to sell something, it will go to NTPC. Maybe it will have to borrow less from the market, but it's not going to help our budgetary numbers. So I think that's the major problem with disinvestment. Ideally, I think disinvestment should not be a part of the budget. You should keep it outside the budget, so that if at all it takes place or doesn't take place, it wouldn't really matter and these numbers don't go topsy-turvy. And for this year, I think the major success for the government definitely has been Air India. Even though I think it has been sold at a low price, but I think everybody's happy because government wanted to get rid of it. You managed to get rid of it. Tata's wanted it, so they got it at a good price. So it's been a win-win situation. But a similar kind of a story is not going to play out for LIC, because LIC is a great company. It's a large company and probably one of the most valued companies, public sector companies. So it's always going to be something which will carry on. But I'll go back to saying that we should not be having disinvestment as part of the budget, because when you're talking about 1.75 lakh crores, I think the last numbers which came out show we haven't even, 1,60,000 crores is pending. Because a lot of these things, that is also merged with ideology. Two public sector banks are there. Now we're not quite sure if you're in a position to actually sell those two public sector banks. So until we're able to crack that ideology, only then can we say we can bring it to the market or get somebody to buy it. So keep it out of the budget. I think we'll have a more realistic budget in that case.
A more realistic budget. Mr. Gopalan, I'll let you have the final word on the show, and I hark back to the point about no instant budgets for the Modi government, certainly no budgets which are very populist. It's always been a sort of middle path approach. Given all of that and your own sense of how the numbers are likely to add up, how would you summarize this budget? Not a budget where there is instant giveaways, and not also a budget which completely remains conservative and doesn't spend to shore up the economy?
Siddharth, I've been seeing the Modi government budgets. They are definitely have a little left-leaning tilt. They do. If you look at the PM Kisan program and those kind of things, I've seen that happen. They have been trying to ensure that the existing programs are implemented well through your, Kisan Yojana and your insurance schemes and those kind of things. They're trying to improve them. See, what I would like them to do also is that you have to create institutions or create an institutional structure, or you have to ensure that institutions are, that are created by some, advancement, some enhancement of your policy initiatives. For instance, if you find that the perishables are not getting marketed in the urban centers, then why not look at a Amul type of a structure to ensure that these perishables are collected and then sold in the markets where the demand is there. So this is a policy initiative which has got to be taken from the budget to ensure that such institutions are created. So it's not something which can come just drop from the heaven. The point about asset monetization, I agree with Madan. The money will go to the organization. It will not come to the government, certainly. But if they create a separate organization, then that organization will be making profits, obviously, and that profit, the dividends can come to the government by way of revenue. Otherwise, selling these assets will go to the institution only. Now, this budget, I don't expect, big bang kind of issues. I expect the same prudence with which the fiscal deficits and other funding, the finances are handled so far. It will be done in that particular manner. I don't think it's going to be something very, very big bang. Focus once again will be on capital expenditure from 5.5 lakh crores, maybe 6.5, 7 lakh crores. There is a limit up to which the administrative system can absorb and implement in the economy. Right. That will be kept in mind when you look at, capital expenditure increase in the budget. That will be kept in mind clearly. And obviously, you may get some inducement to ensure that exports are, done well to take advantage of at this point in time. There could be some programs which I'm expecting. What I'm learning, but that apart, I don't expect any big bang or a path-breaking kind of an announcement coming up in this particular budget. Just to manage them in such a way that the debt levels do not go up beyond the existing whatever 100% or whatever we are talking of. It doesn't go beyond that. So those are the kind of numbers I think the government will be looking into. Very, very conservative way of looking at, but that's good for the economy in the long run. That's what I think the budget is going to.
Absolutely, and we would also wish that this budget addresses all the crucial needs of the economy and the evolving situation on account of the third wave. But as far as the macroeconomic numbers are concerned, this year has been pretty decent, and we can hope that things get sorted out very, very quickly. I'm going to thank all of you, Kaushik Das, Madan Sabnavis, and R. Gopalan, for your time with us today. With that, it's a wrap on this pre-budget special on Business Today Television. If you've been, thank you very much for watching.
As the union budget grips us with great anticipation, how will the fourth budget by Finance Minister Nirmala Sitharaman fare? As we bring you expectations, we will also share with you the contours of all the announcements right here on India Today. Do stay tuned and follow us across our social media platforms. You can also download the app, and we look forward to an exciting Union Budget 22-23.